reconvene the Mendocino County Employees Retirement Association Board of Directors.
That's cute.
And first we'll do is, I guess, pledge allegiance.
Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Roll call next.
Nope. We're not required to do roll.
Okay, so public comment. Members of the public are welcome to address the board on subjects both on and off the agenda. The board is prohibited from taking action on matters not on the agenda, but may ask and or briefly answer questions. Public comment is limited to 3 minutes per person. Anybody here would like to offer public comment? Okay. Consent calendar. Matters in the consent calendar are to be approved by one action without discussion unless the board member requests separate. So what we've got on the consent calendar is the minutes of January 17th and the January 2018 retirement report, along with the monthly preliminary financial report. Any comments, corrections, suggestions for those consent calendar items?
I move approval of the consent agenda. Second.
Well, then,
Should I have said calendar?
well, they're approved then if there's no changes or corrections.
Oh, that's right.
Okay, then we're on to item number 2, which is discussion and possible action regarding investment matters, quarterly investment report.
Yes. Thank you, Mr. Chairman. Trustees, we have Callan here with us today to discuss 3 or 4 items and provide us some additional information on a number of other things. Greg, I'll let you, everyone knows Greg, and I'll let you reintroduce your compatriot, and then we'll just let you guys take over and get started however you want to attack the issues.
Okay, awesome. Well, thank you. I think we have a total of 4 agenda items to talk to you about today. We've got quarterly performance through the end of the year. The quick answer is it looks really good. In fact, too good. So good it makes you worry a little bit. We have the flash report through January, and again, it looks even better. Through January, it was certainly the calm before the storm, which we saw a few weeks ago with the increase in volatility. We have our annual capital market expectations we're going to walk you through and provide you a little bit of an economic backdrop, at least from our perspective. And at the punchline at the end of that one, we share with you the expected return on assets from Callan. And as you know, Callan has our return expectations and the actuary has a different one. Our return expectations for the next 10 years didn't change this year. We can get into that in more detail during that presentation. And then the final item is we're going to talk to you about ESG, environmental, social, and governance. You all asked us to come up and do an educational session on that. So we're going to be talking to you for about 2 hours or so, and I thought it'd probably be best if I bring someone else to do some of the talking. So we have Mark Wood here, and Mark is a member of our manager research group, and he's also a member of a committee we have at Callan, our ESG committee. And that whole committee is designed to help make sure we're abreast of things going on with all things ESG. So Mark's going to walk you through, it's an educational session. We're not advocating one way or the other on the topic, but it's more just to arm you with data and information. Okay? So I tell you what, how about we start off with the capital market expectations. And we sent up a presentation. I trust it's all on your iPads. And I'll walk through this for 20, 30 minutes or so. So I'm going to flip ahead to page 1 on this. And from a big picture standpoint, what are we talking to clients about now? at the beginning of the year. And the first thing is the implications of tax reform. The tax reform bill was a pretty meaningful bill that got passed at the tail end of last year. And it does certainly have implications on capital markets, what companies are going to be doing with capital going forward, the attractiveness of issuing bonds and paying off debt, repatriating assets. So that's one topic we've been spending a lot of time talking to clients about. Probably impacts public pensions a little less than corporate pensions or endowments and foundations where gifting has been impacted by the change in tax policy. The other big topic we're talking about is a theme we've been talking about for years, and that's the comparatively low return environment that we're in today. We've been dealing with this for several years now, where in large part because interest rates are so low and equity expectations going forward are low. What does that mean to investors when it's not likely that you're going to be achieving an 8% return target going forward? Both stock and bond valuations appear high, and that's true at the end of the year and it's still true today. That, of course, is related to the fact that forward-looking return expectations should be modest. Before February, volatility was freakishly low. Not just low, but I mean abnormally low. And in February, we're returning to a more normal state of volatility. But the very low volatility, I think, led to a certain amount of complacency in the capital markets. And we should all be prepared for more volatility going forward. Inflation is benign, but it's starting to pick up. And then finally, a number of investors are talking about ESG. And I'll let Mark spend some time talking about that in a little bit here. So flipping ahead to page 2, one of my comments is that equity valuations appear high right now. Okay, Greg, how do I quantify that? So here's a chart that we put together to try to illustrate that to you. And here you'll see these blue bars. These are the range of forward PEs over the last 10 years for individual capital markets. So the S&P is on the farthest left. The S&P has had a PE ranging from 18 to 10 over the last 10 years. Hey, Lee, we also have hard copies out here. Can you read on that?
Oh, very well.
Can you really? My eyes, I can't.
What's that?
I have a big one in glasses.
All right, good. Works for you?
Yeah, it works great.
Okay.
If I can do the right
Yeah, sure,
report.
we're
Yeah,
supposed to
got
do
it.
that.
So a few of the big takeaways from this slide is that,
I didn't think he was talking ESG first.
no.
There's other stuff
no.
in that report.
It's the same
I
report.
said- Yeah, okay.
Yeah, we're just on page 2 of the same presentation.
ESG is at the end, and I thought, well, I read this last night.
And Greg, as we're dealing with this, can you
Yeah.
stop and explain to us why PE is an important measure here?
Great, well, thanks for that.
And what is PE and why?
Yeah. PE is how much you pay for a stock per unit of earning you receive. So it's the price divided by earning. So if the PE is 18, it means you pay 18 times for the company, 18 times its earnings that you expect it to earn in the next year. So that's the forward PE. The forward component means the earnings over the next year. So right now in S&P 500, we're paying 18 times for the next year's earnings. The question is, well, is that good or bad? Is 18 good or bad? Well, what did I pay before? On average, over the last 10 years, I've averaged paying about 14 times earning. Today, I'm paying 18 times earning. And it got as low as 10 times earning after the global financial crisis. So we're now much higher than it was before. Why would I pay more for earnings? Well, what if I think this company is just going to grow a lot more? You know, the earnings is going to be, next year's earnings is going to be 10% higher the following year. Well, if I believe that, I'm willing to pay more for it because the future earnings are going to accelerate relative to today. That must be what the market is pricing in, at least to some extent. Increased growth and inflation expectations, which flow through earnings going forward, okay? Or it's just a lot of capital looking for a place to go. And I think there's some of that as well. And we have some slides in here about the size of the Fed balance sheet and easy money out there, if you will. Money needs a place to go if it's out in the system. And it can go in the real economy or it can go in investments. A lot of it has gone into investments, which has driven up the price of securities across the globe. So what we're looking at on page 2 here is one of the big takeaways here is that all of the dots are towards the top of the range over the last 10 years. Okay? So things are more expensive today than they had been on average over the last 10 years. Is it because there's too much money looking for investments, or is it because people really expect a lot of growth going forward? Or is it both? It's probably a little bit of both. The other takeaway is that things like US stocks, small cap stocks, growth stocks are higher than the average across the globe right now. If you look across the globe, things like developed markets in Europe and emerging markets are less expensive than the world average right now. So that's a couple of the big takeaways. And one thing, you invest in international stocks, right? So this should be indicate that you are, one, well diversified, but two, you're investing in categories that are a little cheaper than the US right now, which is a good thing. Okay?
Greg, a question. Got a phone call a couple weeks ago from my son who told me he had just pulled all of his retirement money out of the markets. He felt that everything was going to tank. He said, I know you tell me not to do that,
Yeah.
Mom, but do our investment managers, or does Callan have the authority, if people are concerned that things are going to go down, to pull money out of the investments and let it just sit in cash? Or, as you said, that money was looking for a place to go,
Yeah.
of necessity, does that money have to go someplace else?
Yeah. Well, Callan doesn't have the authority to direct any of your money, right? So
I understand that piece. That's not
your
saying-
managers do have the authority to direct the monies within each of their individual funds or mandates. So they will position their portfolios, some more than others, based on what they view as macroeconomic issues going forward. So they might buy more defensive stocks, or they might buy that more value-oriented stocks if they think the market might go down. But we hire them with the expectation that they're going to stay pretty darn close to fully invested. You don't have any managers that will put 40% in cash or gold or run for the hills. From a policy perspective, it's an individual can take their own money and do what they will, and make that bet, if you will. But there are more examples of people failing at timing the market than there are people succeeding, and that's why you tell your son, don't do this, right?
Exactly.
Because the market can stay irrational longer than he can stay solvent. Right? So he can be wrong for a really long time. And on page 4, we actually have some charts that talk about this a little bit. And this is a little bit of an eye chart, so I'll try to explain. What this is showing since 1997, this is the overall price level of the S&P 500. And you'll see that we have 2 peaks. The first peak is going up to the tech bubble in March of 2000. And there you see that the S&P 500 got to a level of 1,500. And then it came back down after the tech bubble. It got to 777. And then it went up to the peak of 2007 in the global financial crisis, and it went to 1,565. So a little bit higher than what it was after the tech bubble. Came back down again, And then since '09, we've been in this, it's pushing 10-year run of the stock market going up. We're now at 2674. All right, so that's a heck of a lot higher. But what this chart, overall level chart, doesn't show is, well, how much earnings are there in the S&P 500 now? Okay, so that PE ratio I talked to you about at the global financial crisis peak in 2007, it stood at about 16 times earnings. And I already told you, today we're at 18 times earnings. So you might say, well, we're pretty expensive if we're above where you were at the global financial crisis. But what was it at the tech bubble? It was 27 times earnings. Okay? So when we were working with clients back then, some clients tried to be tactical and pulled out of the market, and they were wrong for about 4 years. And the performance looks awful after 3 years. And people get fired, and people capitulate on their trade. And you go back into the market, and then the market goes crashing down. And so the timing the market, you need to know several things. You need to know the direction it's going to go, you know the magnitude is going to move, and you need to know when. And having all three of those right is incredibly difficult, and more people lose on that game than win. So we don't recommend that you time the market, even though you think things might be a little overvalued. However, you should manage your return expectations going forward.
Thank you.
Okay?
These are good words to carry forward.
Okay, I mentioned that volatility is low, and was low. Let's look at this on page 5. And 2 line charts here. The one on the left shows the actual standard deviation of S&P 500, so that's how much the S&P 500 moves up and down in actuality. And the right one is this thing called the VIX. You probably hear about the VIX in the paper, right? What the VIX is it's the implied volatility within options. It's the, some people call it the fear gauge, but it's how much options are assuming volatility will be going forward. And if you look in the VIX over on the right-hand chart, we were running at the lowest level on record, and we set an all-time low in the VIX level last year. At the same time, markets kept on just jumping up. And so when we made this presentation, we're like, wow, volatility is really low. This is a little weird. And then February came about, and you see this line, this chart on the right here, the VIX went from 10 up to about 50. Boom, overnight. And during that time, you saw a whole bunch of strategies that assumed volatility would always stay low, lose an awful lot of money. And you saw these ETFs that went to 5 cents on the dollar of what they were before. So people who bet that volatility will always stay low are, it's certainly not a sustainable bet always, and there's very asymmetric payoff to that sort of position. So volatility's been really low. We shouldn't expect it to be low going forward. Okay, let's look at valuations in the bond market, and that's on page 6. Here, this is looking at the yield of something called the Barclays Aggregate, Bloomberg Barclays Aggregate Index. So this is the benchmark for your 2 bond managers, Dodge and Cox and PIMCO. So this is their home base. It's investment grade bonds, maturity 1 to 30 years, U.S. bonds. And one of the things you note here is that for the last 3 years, it's pretty much been flat around that 2.5 range. And there hasn't been like a major breakout until, again, this February, we're starting to see a meaningful increase in yields. In January, you'll see in the flash report that this index was down about 1%. Not a big deal for the equity market. That's a pretty big move in the bond market. So yields are starting to go up, and it's north of 3 now here. So we're starting to break out of this very low range we've had for a long time. Yield and bonds, this is your forward-looking return expectation. So in the stock market, it's kind of, you can't really know because you don't know what's going to happen with valuations, earnings growth. Bonds are a little more certain, right? If something yields 3% and you hold it until it matures, you make 3%. It gets a little more complicated with reinvesting income and all that stuff. But, pretty much you're going to make 3%. And that's where we're sitting at in the bond market right now, which, if I mentioned over the last 3 years, has been pretty flat. But take a look back over the last 25 or 27 years here. It's a lot lower than it had been historically. So if you bought a bond in 1990, you would have made about a 9.5% return. If you buy it today, you're going to make 3%. I mean, that's just a categorically different environment. You're a bond guy.
He's a house guy. A house guy.
Yeah.
Do we buy bonds in funds, or do we buy individual bonds and ladder them so that we're not subject to mark-to-market, a whole fund dragging us down? We can hold them to maturity if we want to in a declining market and not suffer the consequences over a long period of time?
So you buy funds, which the manager then goes out and invests in bonds across the spectrum of maturities. That bond fund is valued every day. So you'll see the mark-to-market every day. As opposed to, if you bought a laddered portfolio and you held it at a custodian, and you buy a 30-year, if you buy a 10-year treasury that's yielding 3, and you hold it to maturity, that would be mark-to-market too.
Well,
So-
I'm thinking like buying bonds maturities are like 3 to 4 years.
Yeah.
So that if you're on the wrong side of the interest rates, you can hold them, you can suck it up for 3 or 4 years.
Yep.
And not take the hit on your mark-to-market of a bond fund,
Yep.
which is constantly reinvesting things in there.
So-
Everything gets kind of
Yeah.
dumbed down.
So that bond with the same amount of interest rate risk as these bonds, you would still mark that to market.
Mhm.
It still goes down in value, even if you hold it to maturity. You will have the same return at the end of the day,
Right.
but they would both be held to maturity. So if I buy a 5-year bond that's yielding 3% and interest rates go up, that bond is going to be marked down in price, right? Even if I know I'm going to hold this to maturity and eventually it's going to get back to par. Okay, so you still have the whole mark-to-market dynamic even if you have a laddered portfolio.
But with shorter maturities,
You have
you're
less
gonna
interest
get-
rate risk.
You're gonna get hit a lot less hard
That's right.
on the markdown.
That's right. So what, so you
What I'm saying
could,
is keep them short
yeah,
so that your markdown is much lower and
Yeah.
your risk is.
yeah, your interest rate risk is less.
Right.
And right now, both of your bond managers are at least a year short in duration relative to the index. So both of them have that point of view that they think interest rates could go up. They're expressing it 2 different ways, Dodge and Cox and PIMCO, but both of them have less interest rate risk in the portfolio now than is in the broad market. But having said that, they're not at a 2-year duration.
I'm sorry, say that again?
So Lee's saying, well, if you have less interest rate risk, if interest rates go up, you lose less overnight in a mark-to-market environment. And I say, that's correct. And your bond managers are expressing that view right now. Because both of them are tactically underweight interest rate risk. They have a shorter maturity, a shorter duration right now than this index has. And when you go to these managers, you say, I want you to beat this index because this is my strategic policy benchmark. I want you to beat this benchmark. And they are all under risk that benchmark right now in terms of interest rates. And when we get into the performance report, I'll show you that in a little more detail.
Thank you.
Okay. Spreads are tight. That's the big takeaway on the next page. Page 9, I think this is an interesting chart. First, page 8, people love this chart. I don't have a lot of profound things to tell you about it, but people love looking at the colors. And what it really is meant to do is to reinforce that the same market is not always the best performing market. And that's why you have diversification, right? That's why you don't put all your eggs in one basket, because at one point, large cap growth stocks always perform really well, and then they're at the bottom of this chart. So look at this one in your leisure, but I think 9 is really interesting. And what this is looking at is the cross correlation of stocks within the S&P 500. So it asks the question, are stocks acting different from each other, or are they all just acting like the market? Are they all just going up and down in lockstep with the market? Or is one doing well, the other badly, and is there diversification within that stock market? So for a number of years, we have been running at an abnormally high level of correlations of stocks to the broad market and to each other. And that's a really tough market for active managers to do well, because you hire an active stock manager, they say, okay, my job is to differentiate between Apple and Google. But if Apple and Google are just all going up and down together, there's no differentiation. You may as well be in an index fund. But now, you look at the last year, the correlation has gone down a lot. So that's an opportunity for active managers where they actually can add value, one stock relative to another. This is a big explanation why, in part, your active managers have actually done really well. When we get to your US equity managers, they had a great year. They looked really good. And this is one of the reasons they did, whereas before, there wasn't as much opportunity. One of the takeaways for me is that you have both index funds and active managers. You have index funds more in large cap than anywhere else, or only in large cap than anywhere else. And that's expressing a point of view that these things, active versus passive, goes through cycles. Sometimes there's opportunities and sometimes there's not. That's why we got both. Okay. Let's look quickly at page 10 here. And here we look at, in rearward-looking fashion, what were the returns for broad markets over the last several calendar years, and then over the last 5, 10, and 15 years over to the right. Let me draw your attention to the last 10 years. And so I'm circling this column here, and I'm going through and I'm looking at all of the broad markets. So last 10 years, US stocks are up about 8.5%. International stocks are up about 2%. Bonds are up about 4%. Real estate 6%. You don't have hedge funds or private equity, but they're up 3 and 8%. Cash is 0. And then commodities are the only thing that's produced a negative return over the last 10 years. It may not feel like that, but it's been a truly incredible capital market run over the last decade. It's been one of the best that you could expect, and commodities are the only thing that's returned a negative return over the last decade on this chart.
Go buy gold.
Gold and oil.
Oil.
So this is really driven by oil. Remember, oil was supposed to be, the new super cycle of oil. People were talking about that 10 years ago. I'm going to load up on real assets. And oil was priced at, it was 110, 120. It's 10 years later, it's 50 to 60 today. It's half of what it was 10 years ago. And it also goes to show that, there are these little trends that go through our market. Listen to them, learn from them. Don't always hop on the hot bandwagon. And don't put all your eggs in one basket.
No Bitcoins?
I forgot what I was going to say.
Bitcoin, that could take me off tangent for a long time.
Well, that oil shale is what they call it, fracking, has
Yeah.
just been the market disruptor there. I mean, whoever dreamed of fracking 15 years ago?
Yeah, the US has
I
become,
mean, if it wasn't for
A
that,
true rival.
oil would probably still be.
it could be, if OPEC could control the price of oil, they would probably like it higher than where it is today, right?
So would Russia.
So would Russia.
Yeah.
And the US is an exporter.
Whoever
Oil,
dreamed of that.
natural gas. Indeed. So looking at the 10-year return column, you might ask, okay, Greg, you're going to tell me what your forward-looking return expectations are over the next 10 years. And across the board, they're generally lower than these, but they're pretty darn close. So what did we get wrong 10 years ago making this forecast? We were pretty spot on with the US stock market. We were pretty spot on with bonds. Real estate was pretty darn good. Private equity were a little higher, but yeah, it's a weird thing to measure. Commodities being negative, we didn't bet that, but we thought it'd be just a few percent positive. So we were a little bit of an outlier there to the rest of the market. But what has been truly disappointing is international stocks. So to invest in international stocks for 10 years and get a 2% return on average has been disappointing. And it's not something that we would have, we predicted 10 years ago. And a lot of this has to do with the currency. So the US dollar has weakened appreciably, about 10% on average versus our major trading partners over the last year or so. But before that, it had an incredible run. And the US dollar, when the US dollar gets stronger, if you hold international securities, they get less and less value when you repatriate them into US dollars. And that's been one of the larger factors in international markets. If you go out to 15 years, yeah, they look more normal, right? 8% return and 13% for emerging stocks. So what this means is that even long time periods like 10 years, sometimes they're not even long enough to get to that normative environment that we expect.
Greg, if I may, before you leave that, this also, what you're talking about there also drives the point of when you're looking at a 10-year growth number, the only thing you pay attention to is the beginning and the ending. There is no consideration of what path you took to get there.
That's right.
So I just wanted to point that out. And a year from now, those numbers could look very, very different if the dollar continues to weaken.
Very, very much so.
I also wanted to ask about you didn't touch on inflation expectation. 10 years ago, I suspect you were not at a 1.5% inflation expectation.
No, indeed, we weren't.
3.5?
It may have been about 3. I'd have to pull it. It was certainly higher than today our inflation expectation is about 2.25.
Right.
And it was at least 1% higher than that, if not 1.5% or so.
Okay.
Yeah, indeed. Very, 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 very different.
And to me, that's the difference there is significant because how the inflation rate plays through every other market. When you build an expectation of return going forward, you start,
Yeah.
you got the three factors, the GDP growth, inflation growth, and then dividend growth.
Right.
Inflation growth is huge.
Indeed.
So, just wanted to make that observation.
Yeah, indeed.
But are you entertaining questions, or you want to?
Yeah, sure. If you want to ask a question, sure.
So, help me understand then why the UK is doing so much better than the continent.
Well, it's a little bit out of my area of specific expertise, but here are a few things.
Okay.
One, the UK's banking system has been generally stronger than the banking systems in Europe. And so if you look at Italy and Spain, Greece, Portugal, Ireland, they used to call them the pigs.
Yeah.
And so the banking system in the UK has been stronger. Germany has been quite strong.
Right.
And so if you kind of look at the European economies, Germany has probably been stronger than the UK, actually. But it's really the rest of Europe that's really struggled. France seems to be making very forward-looking reforms right now, excuse me. And so I think there's some glimmer of hope there. Because Americans always complain about the French employment laws, and do they work a lot?
Taking August off.
Exactly, that sort of thing. So I think there's certainly some progress there in France, and if you look at the economies, I mean, it's in Europe, it's ex-UK, I mean, it's Germany and France, and then everyone else. Italy's the next, and then they're not huge economies when you outside of Germany.
I saw that last night, and I wondered if it had something to do with their pulling out of the euro.
Well, the euro, it could be a headwind for them from a growth perspective because of trading alliances. We're in the financial market, so could be a lot of jobs leaving London, going somewhere else if they're not part of the EU. The ability for workers to go over there and work, the productive workers. So that could really be a headwind, and it's also could be quite inflationary for the UK. So if the British pound goes down in value, everything they import gets more expensive. If the pound is, it's hard to measure all these things, but if the pound is weaker than the euro, then all their imports are more and more expensive. And inflation, later this slide we have something that shows that inflation in the UK is actually running a lot higher than in the US. Part of that has to do with the Brexit.
Just because I have a trip planned to London.
It would have been cheaper a year ago.
Every time I've been to England, it would have been cheaper.
Timing is everything.
The pound always goes up in June. Count on it.
Before we leave page 10, so just looking at the chart, under the bottom of it is inflation, consumer price index, urban. I think that's what that is.
Yes, that's right.
So it's showing over the last 15 years, it was 2.08, and then 10 years, 1.61. So what I think you were saying earlier is you had a higher expectation for, as a background, looking prospectively for inflation, but in fact, it was actually fairly low.
It was.
Okay.
It was very low. And for the cash is closely, the return on cash is closely related to inflation. And our cash expectation was low, but the inflation was low, so the Fed kept Fed funds rate at 0 for, was it 9 years, 7 years?
Mm-hmm. We're finally leaving that. So.
We're just leaving it now, but that's, we'll see it charted a little bit here. The Fed generally moves the Fed funds rate. To have it be the same thing for 7 years is wacky.
Yeah, Japan.
Let alone be 0 for 7 years. But just like the same thing forever. And it's not normal. So no, we certainly didn't foresee that. We did not foresee that.
She didn't do that.
And just to interject too, I think Greg mentioned the commodities. If you look at the return on commodities, a lot of that can drive some of the inflationary pressures, and we just haven't seen that as China has slowed down and their consumption of resources throughout the globe has declined with it, and that's drawn sort of a global deflationary environment. And so the US, it kind of bifurcated. I mean, if anyone has kids going to college, the price of college has gone up, I think, 200% in the last 15 years. But on an inflation-adjusted basis, the price of your television has gone down 90%.
Yeah.
So there's like this interesting divide between technological change driving some price wins for the consumer, and then healthcare and college costs going up exponentially.
Well, thank you.
Sure. Okay, I'm gonna flip ahead to in the interest of time to page 13, and here we just look at a few macroeconomic factors. Here on page 13 we show GDP growth. The green bar here, that's a forward-looking estimate from IHS Markit, used to be called Market Insight. So GDP growth next year forecast to be about 2.5. So a little higher than the previous year, but certainly not at the 3% rate some people are targeting, let alone the 4.5. And this includes things like the tax reform impact on GDP growth. So we're not in a categorically different world than we were over the last couple of years, but it is up. It's higher than it was expected to be before. The other takeaway on this slide is that since the global financial crisis, our GDP growth has been consistently positive. People may not feel that way, and they may not feel that way because it's been positive, but it's been muted. It's been averaging about 2%, whereas pre-global financial crisis, growth was averaging 3.2% for the previous 12 years. So it's not that growth hasn't been there, it just hasn't been as much as it had been before. And similar to James's point earlier about inflation, GDP growth is a key input in making forward-looking return expectations. On average, earnings should grow, a company's earnings should grow something close to the level of GDP growth, right? So it's a key building block about earnings growth going forward. Earnings growth plus inflation. This GDP growth plus inflation is how much earnings should grow on a nominal basis going forward. So I mentioned that it's been a slow recovery, but it's also been one of the longest recoveries we've had on record. And page 14 is showing this. So we're pushing 40 months of economic recovery here. 40 quarters, sorry. And that is, right now, it's the third longest, versus the second longest, third longest expansion we've had. Ever, right? So it's been incredibly long. Expansions don't die of old age, right? But they die of other things. So this isn't to say it's been a long time, so we're going to enter a recession, but it is noteworthy that it's been quite as long as it has. But one thing also shown in this chart, I'm looking at the chart on the far right on page 14, the light blue line at the bottom, that's the current expansion. So you see it's going a long way to the right, but it's a whole lot lower than all the other lines. So we're taking off, but we're just kind of, we're low. We're flying low. We're keeping it low. Low and slow. So some people think that this is a reason why the expansion could continue on, because we haven't used up all of the excess slack in the economy. The flip argument to that is on page 15, where we look at the unemployment rate. So what this chart shows is the blue line is the unemployment rate, and the green bars up top are GDP growth. Let's just look at the blue line. We're now sitting at a 4.1% unemployment rate, which is lower than we were pre-global financial crisis, and a heck of a lot lower than we were at when we're pushing 10% in the peak of the global financial crisis. Most people would say that we are below what you call the natural rate of unemployment. So that's, okay, if we're in a normative economy, how many people are out of work just because they're changing jobs or something happens, you know, people lay off, other people employ. You're always going to have some employment in an economy. That's just the way the economy works. So most of the time people think that should be, 4%-ish. When I was in school, people said 5%. Right? For some reason, economists think we're more efficient now, so it's less than 5%, but maybe it's 4.5. Either way, 4.1 is lower than what most people expect to be the long-term natural rate of unemployment, which should mean that inflationary pressures should be building. They haven't yet meaningfully, but maybe there's some green shoots that we're looking at now.
James?
Greg, I know we talked about this previously, but there's a lot of talk and a lot that is written in the industry about how the unemployment measure may not be as relevant today for measuring capacity because of movements towards the gig-based economy, and there's so much underemployment out there still. What are your thoughts on that? Does that give us a little bit more slack, you think, or is that not really a factor?
Underemployment is improving, and there's a chart here on page 16 that shows that. The gig economy, that's harder to measure, right? Are people doing the gig economy because they like the lifestyle, or are they doing it because they need to hustle to make more money? It's probably both, and the latter. And people would probably like, they might like the lifestyle of driving an Uber, but maybe they want to be doing something different too. So the chart on the left shows something called the marginally attached but discouraged worker. And James, you're an economist, right? All right. So economists have all these funny terms. So marginally attached means that you're would like to be working, but you're not. You're not quite in the workforce, but you kind of want to be. You haven't looked for a job in the last few months, but maybe in the last year. But so you're discouraged. Like you don't feel like there's a good job for you to be looking for right now. And that number has gone down a lot. So that number used to be about 1.5 million or 1.3 million people. And that peaked in about 2011. And we're now down to about 500,000 people in the United States called in this discouraged worker category. So that's a huge improvement. James, do you want to explain what the gig economy is?
So the gig economy is sideline, consulting business, driving for Uber, working for Jackrabbit, being a dog walker on the whatever the app is for dog walking, these kinds of things that are largely driven by technology these days. Uber is all about Uber is just a matching service, is all it is, and there's a number of those for that people can do. Sign up to work on a small-term project type basis, and even Airbnbs and VRBOs are type of gig economy work. So,
ways to get paid, but
Like
maybe you
this.
don't have the.
I was gonna say, yeah.
I'm only here for a minute.
That's funny.
So, Lee, this is your side hustle then, right?
Now I'm retired, I gotta make it where I can.
So I think the young people, Mark, do you call it a side hustle? Do you have a side hustle?
No side hustle. Callan keeps me,
Keeps you busy enough?
busy and on target.
I call it consulting, but
Say independent contractor,
Yeah.
is the preferred term.
Growing marijuana.
Yeah. So,
That works for you.
yeah. One of the issues with the gig economy is that there are fewer benefits. The work isn't as steady. And some people like that, right? They work when they want to work, right? But it's just less stable. How's our consumer doing? Consumer, of course, is 2/3 of the GDP. Consumers feel wealthy right now. Right now, the household net worth is at the highest it's ever been. We know that this is not equally distributed, though. This is not everyone feeling this way, but if you roll up all the households in aggregate, right now they feel more wealthy than they've ever had before. But the savings rate is also low. People aren't saving as much. After the financial crisis, people got religion and started saving a lot more money, but we're now down to a similar level where we were in the 2007 time period in the savings rate. Personal debt is increasing, and a lot of it is, so this is the Fed, I think this is St. Louis that do all these measurements. Come in different ways to measure, okay, how tapped out is the consumer when it comes to borrowing money. And consumer debt is higher than it's ever been. And a lot of it is, a lot of the increase, if you look at it, is actually student debt. So student debt 10 years ago was about $618 billion, and student debt today is $1.5 trillion. So over 10 years, it's almost tripled. The next few charts show that people are spending. They're spending a good amount of money in things like boats. So people have disposable income, and they're spending a little more similar to what they did pre-global financial crisis.
Travel trailers.
Travel trailers, that's the thing.
Well, here,
Yeah.
because of the fires.
That's true, yeah.
Only 'cause they
Got
have
markets
to.
booming.
Okay, so on page 20, what's inflation looking like? So this is, we've talked about inflation a few times. These are a few different measures of inflation. We have CPIU, which includes things like food and energy. And you'll see, as Mark alluded to, when we went through the energy downturn in 15-16, CPIU was running lower than broader inflation, but it's now higher than broader, and we're actually north of 2%. That 2% number is meaningful because that's what the Fed says they target. They use even a different measure, and economists all different types of measures to inflation. But we're getting to a point where the Fed certainly feels like they have the latitude to increase interest rates, growth seems stable, and reduce the size of the Fed's balance sheet. Consumer sentiment is on page 21 to the left. Consumers are feeling pretty good right now. So higher than it's been since 2007. So consumers feel good. There's a little bit of mojo out there in consumers, in part probably because their household wealth is high. There's higher employment, and people feel better about growth going forward. Hourly earnings is ticking up. We actually in January, I think we saw it tick up a 0.6 in hourly earnings. So we're starting to see a little uptick in salaries going up. Yeah.
As someone who went to Michigan State, I'm very offended at the slide on the left.
University of Michigan.
Yeah, no, I see
Sorry,
that, yeah.
you know, we like big blue. We're not into the green.
Not a lot
No,
of people are
uh,
claiming to be from Michigan State these days.
Yeah.
That's true.
I could have taken the joke in a different direction.
Midwesterners are so kind.
Okay, let's talk about the bond market real quick. Flipping ahead to page 23. If you take a look at the chart on the right, these are, this is the yield curve. So what this is how much yield you earn from a bond for each level of maturity. So if you go out to 30, that's a 30-year bond. They're yielding about 2.5 to 3%. If you look at the short end of the curve, that's like a 1-year bond. It's yielding today about at least at the end of the year, about 1.25%. The yellow, blue, and I don't know what color that is, grayish lines, they all look really similar to each other. They just maybe up and down a little bit, and I mentioned that for 3 years we're kind of stuck in this range. You're seeing that. But if you look at the end of 2017, it looks different, right? It's starting to look pretty different. And it's because the shorter maturity yields are going up. People are demanding higher yields to invest in short-dated bonds. And it's because the Federal Reserve is increasing interest rates. And the market, for once, is believing the Fed. When the Fed says, I'm going to be increasing interest rates, the market believes it. So the short end of the curve is going up. At the end of the year, you didn't see long rates going up much, but that changed in February. So in February, we saw inflation expectations, yield expectations go up across the board. And one thing that I think investors need to worry about a little bit is the correlation of the bond market to the equity market going forward. So in February, bonds went down in value, stocks went down in value at the same time. Most of the time, you expect them to counterbalance each other. But now the stock market is reacting to the fact that the bonds are selling off. And in those environments, there's few places to hide. You know, there are few things that can buoy your portfolio. I'm going to try to keep us moving here. On page 24, we show this thing called the dot plot, or the dot chart, dot plot. And what this shows are the actual people in the Federal Reserve who determine what the Fed funds rate is going to be. And they go up to a chalkboard like this, and they put up a little magnet up on the board and says, okay, this is what I think the Fed funds rate is going to be at the end of 2018, then to 2019, and then to 2020. So the people who actually control the rates, they're saying this is what I think it's going to be, right? A couple of big picture items here is there is not a lot of agreement. Like if you look at these dots, look at 2019. A few cluster around 2.75%. But one person thinks it's going to be 1.25%, the other person thinks it's going to be 3.5%. So the people who are the experts and control it, they don't agree about what it's going to be in a couple of years. That's why we have capital market uncertainty, right? Because people can't agree on what they think the economy is going to be doing going forward, and let alone what the Fed funds rate is going to be doing going forward. So that's one takeaway. The other takeaway is that, but across the board, they are starting to say rates are going up. We all think rates are going up. So at the end of this year, the mean outcome here is about 2.25% for the Fed funds rate. So people think the Fed governors think the Fed funds rate is going to be about 0.75% higher than it is today at the end of the year. And the Fed has been saying that for a few years, but the market had been discounting it, saying, I don't believe you. I don't think you're going to do that. But now they are, the market is starting to believe that. And on page 25, we show here the Fed funds rate over the last about 18 years or so. And here's that chart I talked about where there are a few takeaways here. You look at the green line, it's either going up or down, and over a few quarters it's flat. But the Fed is normally doing something, right? But for 8 years it didn't. It kept it flat. So we've become accustomed to an environment where the Fed's not moving the Fed funds rate a lot. And now we're going into an environment where it's going to start moving a lot more. The other thing is, what is normal in the Fed funds rate? If you look at over this time period, normal to me looks like it's north of 3. Right? And so we've got a ways to go.
It's kind of funny too, when you look at page 24, it looks like there's more of a consensus in the longer term from this group.
Yes.
Like you don't have these outliers, which is kind of, you don't have these big swings like, from 4 to 1.5 or whatever.
That's right.
Which is kind of interesting too.
Yeah, there's one gloomy person there who says
Yeah.
our new normal is 2.25, but there seems to be a little more consensus. It's 2.75, and that's more of an academic argument. What's normative policy for us, right? But normative policy is lower than historic policy, right? So that's another takeaway. What they forecast normative policy to be going forward is lower than what we've experienced historically. Final chart here I'll show you here is the Fed has been doing a few things. One is the Fed funds rate, and the other thing has been they've been expanding their balance sheet. So they've been buying treasuries and mortgages in an attempt to spur the economy and to take volatility out of the market to some extent. So they grew this balance sheet from, $800 billion up to $4.5 trillion from the global financial crisis to today. So $4.5 trillion is sitting on the Fed balance sheet. The Fed doesn't feel like they have to keep all of that on their balance sheet anymore. And what they had been doing is if a bond matured or interest came in, they would just buy another bond of equal value. What they're going to start doing is they're not going to be doing that anymore. And the Fed balance sheet is going to start going down. And over the next year, the Fed balance sheet is going to most likely is going to shrink by about $450 billion. So by 10%. Most people equate that, economists equate that to about a 1% increase in interest rates, the equivalent of taking liquidity out of the market, of slowing down the market a little bit. So the Fed funds rate is the thing that gets a lot of headlines, but the decreasing the balance sheet is also a real meaningful thing that the Fed's going to be doing going forward. I'm going to flip ahead.
Who's gonna buy all the MBS? And are they gonna buy them at rates anywhere near what the Fed's been paying for them?
They will buy them if yields are higher. People will buy them if yields are higher, and that's
Is it gonna drive real estate down?
Well, it's certainly in a rising rate environment. It's harder for people to borrow money and buy property.
Drive up cap rates.
It drives up cap rates, and it also drives up the discount rate for anything. So in theory, the amount of money you're willing to pay for any investment is its future cash flows divided by a discount rate. A stock is the same way. It's your future earnings divided by a discount rate. A bond is future income divided by a discount rate. The discount rate is changing, right? With the risk-free rate is going up. So the amount of the thing that you discount by is going to go up. That's why, in part, one reason, stocks and bonds could be correlated going forward. Because the thing that discounts the value of a bond also discounts the value of a stock. It's not the only thing driving it. There are technical factors, liquidity, and global money flows, and all of that. But it's certainly something that could impact both markets at the same time.
If the U.S. owns $4 trillion in bond or in U.S. notes, does that mean we don't really have a $20 trillion national debt? Because wouldn't $4 trillion offset it?
Well, it's not all. Some of that's mortgages and some of that's treasuries. The treasury component's about $2 trillion. But do we still?
Do we owe it to ourselves?
And well, in that case, kind of. But it's a complicated, weird story there, and one I can't say that I'm completely proficient in. But the U.S. Treasury needs money. Right? They issue debt. The Fed buys some of it.
Mm-hmm.
Interest rates are low. The servicing of that debt is low. The Fed doesn't have as much of this going forward. Interest rates go up. The servicing of that debt goes up too. The amount of interest you have to pay to issue new debt going forward. So I don't know if that answers your question. The Treasury still owes someone this money, whether it's the Fed or someone else. The Treasury still needs to borrow this money to fund its operations.
So the Fed prints it? I mean, at some point, the money has to come from somewhere, so I take it the Fed just prints the money to buy the Treasury notes from the Treasury?
Oh God, I used to know this. It's not directly printing of money, but indirectly it is printing of money.
We're back to Econ 1A.
You know what, I
Too long ago.
forget the details about how they actually acquire these, but it's kind of like printing money, but it's not literally printing money. The purpose of what they're trying to do is increase the amount of money and liquidity in the market, though. Right. Okay, I'm going to flip ahead to page 41. And here you'll see our forward-looking return expectations. They're not dramatically different from last year's. And in part, that's because last year, we took down our return assumptions by about 50 basis points. So last year was a very big move for us in changing our return expectations. This year, we say, okay, it's still reasonable for a 10-year forward-looking outlook for us going forward. That means on page 43 that if you ask Callan what's our 10-year geometric mean return going forward, it's about 6.4, same as last year. And the 1-year arithmetic return is about 7.2. So I know those are two different numbers, and you talk to your actuary about what they want to use, but this is what we think expected return is going forward. We have a volatility assumption of about 14. That means in any 1 year, we think you'll make about 6.5% to 7% plus or minus 14. Wow, okay.
Yeah.
So either that means we're really bad at forecasting, or the things you're investing in are really volatile.
Yeah.
And maybe it's both, who knows. But what does that mean? On page 44, you have to assume volatility to have a forward-looking positive return expectation. We have been in a low volatility environment with the Fed keeping volatility low for a long time, and we've generally had positive returns for the last decade. We haven't had a lot of big drawdown markets. But implicit in this forecast is we're saying that, yeah, we think you'll make about 6.5% to 7%, but there's more volatility in here than we've experienced over the most recent past. And so what that means on page 44 is that over any 1 year, we think that you might be up 28%, but we think you might be down 11.5%, 10% of the time. So 1 out of 10 years, we expect a negative 11% return.
Or worse.
Or worse. 1 out of 20 years, we expect probably something like negative 16. So it's been a really good ride for us, but it can't go on forever, and we know that we have to be able to stomach some of this short-term pain to be able to achieve something close to a 6.5% return going forward. So I wanted to kind of end with this because it's been such a smooth, abnormally smooth and positive ride. But if I come back here next year and we're down about 12%, that's normal. And so it's certainly it's something that we should be prepared for. I'm not calling it, I'm not predicting it, but that's very normal for us.
Greg, on page 44 there, it's, if we were to continue projecting that out, 20 years, 30 years,
yes,
40 years,
yes.
50 years, I notice how these bands get narrower and narrower. Would that narrowing of the bands continue if you projected those out further?
Yes. The narrowing, yes. Yes, it does. You become a little more certain in your forecast the longer it goes out.
Okay.
Yeah.
But you'll only do 10 years.
Well, we did in this exercise. We have done, and we do other modeling for like 30, 40 years. And that's a tricky one, because if you go out past 10 years, you have to make some sort of assumption. Okay, we talked about what the normative environment was before. You have to assume, okay, like right now we're in this environment. 15 years from now, we're not going to be in this environment. We might be something that's more normal. So then you have to tack on to your 10-year assumptions some normative state beyond that, which is higher yields and probably could be higher returns. And I know that, I trust that that's some of the work that your actuary does. When they get out past 10 years, they're saying, okay, yeah, that's the next 10 years, but 15 years from now, treasuries might be yielding 6%, might be yielding something more normal than today. And so you've got to link in the 10-year plus the 20 to 30-year time period, and it becomes a different, totally different exercise. I know for people who don't deal with all this stuff, that sounds like a whole lot of mumbo jumbo, but that's the general thought process. We know what we believe over the next 10 years, and then beyond 10 years, it's something that needs to be more average over the long run.
So have we averaged out 2008 and 9? Yeah. Are we sort of past that, or?
Yeah.
Okay.
We are. We're at a higher market level than we were before the global financial crisis. So it's a heck of a bumpy ride, but you know, if you invested through that whole thing, you would be better today than you were then.
Okay.
But it was a very bumpy ride getting there.
That's the understatement of the year.
Any other questions about capital markets?
That was good. Thank you.
Maybe before we go to ESG, we take a 5-minute break.
Okay, great. Yeah, absolutely.
Because I walked in. Try to forget about it.
Why do capital markets use PE ratios when real estate uses?
And if we can resume with the ESG exhibition.
Great. Mark's going to cover ESG.
Thanks, Greg, and just a little background on myself. I started Callan about 5 years ago, and my primary focus is in with the U.S. equity research. ESG is just one part of that responsibility, and as we'll get into, Callan has sort of developed an ESG committee to kind of cover the space from all different angles. But if you turn to slide 46, just a quick outline of our discussion of what we sort of thought would be a best use for an introduction education today. We'll just touch on kind of high level how Callan looks at ESG from the formation of our committee and how we cover the universe to really defining or lack of definition of what ESG is. I think that's one of the toughest questions out there today, is that there's not a consensus on what the definition is. We'll move on to the Callan survey, just some high-level thoughts on a survey we conduct with asset owners every year to see where they are implementing ESG or where they are not and why. We'll move into what investment managers are doing, how they're adapting or potentially greenwashing, which is a new term out there, and kind of window dressing but maybe not really doing ESG. And finally, sort of ESG research. What are the nuts and bolts of the data that's available? What has Callan done research-wise, and what are some of our conclusions about both kind of our view on the efficacy going forward and how investment managers can implement and asset owners can potentially implement into plans. So just moving on to the first section, slide 47. Really, ESG stands for environmental, social, and governance factors. But it's truly an umbrella term that encompasses a spectrum of definitions that we'll cover in a little bit more detail. It's a rapidly evolving space. As a lot of you have probably heard, there's a lot of different plans taking actions. I think one of the most notable recently was New York public plan talking about divesting of fossil fuels and exploring that option over the next 5 years. So that's just one part of this whole spectrum. Callan's approach to ESG, we have a data-driven and an informed neutrality. We look at it from all angles, and we try to really understand it from the client perspective, the investment manager perspective, as well as the data perspective and the academic perspective, and really where do these all meet, and how can we best serve our clients to get them kind of the factor exposure and ESG implementation that they may want or may not want. And it's really kind of a tough question, and there's not a one-size-fits-all.
Does everybody in the room know what an ESG means? I'm just wondering if I was sitting in the audience, I might not know what the term is.
That's a good question. Yeah, I guess the highest level definition, environmental, social, and governance factors. So environmental is a factor within a company. How are they using their resources? Are they polluters? Are they implementing better practices to recycle within the company? You know, what's their contribution to carbon out in the environment? You know, it's really looking at how are they impacting the external physical environment. Social factors are, you know, really how do they treat their workers? You know, is this a sweatshop in Asia, or are they giving good benefits and treating their workers to a better pay rate? You know, a system like Costco where you have a low employee turnover rate because they treat their employees well, or you know, Nike, as I mentioned, kind of a sweatshop. It's like, you know, that those are kind of the extremes of the spectrum, but there's a lot of gray in between. And finally, governance is probably the most prevalent issue we've seen. A lot of companies have been implementing different governance, and it's been analyzed by stock researchers for a long time. It's looking at, you know, how do they allocate capital? What's the composition of the board of directors? You know, how are they paying their executives? What's the incentive structure? And different ways that the company is managed from a high level and how that translates into long-term returns. So I think that's kind of broadly what those three terms mean. In our discussion today, I think ESG is more related to, you know, how do I incorporate non-financial factors into my investment analysis? You know, how do we go beyond this discussion of PE and price to book and GDP and inflation? And how do we look at, you know, is this company a good actor or a bad actor? And how does that roll up into a total portfolio context? And how do I look at that from, you know, a board seat at the whole portfolio and where we have different exposures? And I think that debate right now is, you know, heightened after, you know, certain events in the real world, such as what happened in Florida, right? You know, folks are looking and saying, geez, do we have a lot of exposure to assault rifle manufacturers? Is that something we really want to have dollars allocated to? And, you know, is that something we need to think about or underlying constituents want to think about? So I think that's why this debate and discussion kind of is not one size fits all. It's very, very much based on what sort of the values of the organization and the common shared interests of the group are. And once you can kind of come to a consensus on what those shared values are, then you can have a discussion on what can we look at to implement an ESG lens in our portfolio. So I hope that helps kind of set the stage a little bit. But good point.
Can I?
Yeah.
Having been exposed to this relatively early at CalSTRS, when we are sitting and all of a sudden we have a group of 40 Stanford students coming into a board meeting and demanding the board vote in a particular way. And
Wow.
I saw our board be so taken by the students and how enthusiastic they were that they voted in a particular way.
Wow.
Because there was no policy, no ESG policy. So that hasn't happened to us yet. But I think we need to think about how we preclude an overwhelming appeal that we vote in a way. For instance, CalSTRS does not invest in tobacco. Then we sit down and look at our bottom line, and over a 3-year period, we'd lost over $1 billion because we were not invested in tobacco. So you have to, we as fiduciaries have to be able to say, that's wonderful, that's exactly how I would vote or how I would act, but what is the impact that it has for the members of our retirement association? So even though we'd like to, you know, kind of think, let's have it go away.
Well, and just to piggyback off of that, and I'm not sure if you, because you mentioned fossil fuels in New York, I think it was the San Francisco Board of Supervisors wanted their retirement board to not invest in fossil fuels.
Mm-hmm.
Of course, they couldn't mandate the retirement board to do anything, but they actually passed something at the board level to, I guess, advocate for the retirement board to stay out of fossil fuels. So I think Jerry's exactly on track that it is something that is, it seemed like it kind of actually calmed down a little bit. Now it seems like it's kind of coming back.
It's cyclical.
Yeah,
Mm-hmm.
yeah.
San Francisco is interesting. If you ever see one of their purchase contracts, it has at least 3 pages of, well, you can't invest in diamonds, you can't, you gotta have this kind of policy with your workers and that kind of policy, and you can't do this. It's literally, there's 3 pages of all the things that the purveyor has to pledge that they're not doing. But you might explain too the 2 basic types of ESG involvement that a board would take with companies.
Yeah, as Lee's alluding, really stealing some of my presentation here.
Good job.
When you get around to it.
I was saying, are you saying at sort of the company level or sort of board?
Well, on the passive level, you know, we just won't invest in anything that has cigarettes versus we want a seat on the board.
Yeah, I guess we can sort of jump ahead if you want, but really, you can look at, you see there's 2 broad spectrums where you have sort of a negative screen, like don't invest in fossil fuels or, you know, South Africa, apartheid related type investments, diamond mines, whatever the case may be. You just say X out any company that has this criteria. You know, if they are domiciled in this country, we don't want it. No Iranian companies. So that's one approach, kind of the most basic, really, a negative screening. The second is the more engaged approach, where you're using your proxy votes and your ownership of these companies to vote a particular issue and a proxy, and, you know, sort of have your voice heard to management that you want to implement change at that board level. And so you may have seen recently that Larry Fink, the CEO of BlackRock, one of the largest asset managers, has sent a letter, an open letter to all the companies, which BlackRock is generally one of the largest shareholders of companies because they have so much index assets, that they need to be good actors. And it was a very sort of broad term, but a big sea change from being a, quote, passive manager in some ways. And so it's kind of entering a new paradigm of what does it truly mean when they start voting proxies with more of, you know, kind of their values assessment versus, you know, just going with management. So I think those are kind of the 2 divides that we're really entering into, and it's a rapidly evolving space, especially with someone with as much purchase in the asset management community as, you know, BlackRock.
I don't think we're going to get into the active role.
No, it's really interesting. It actually took me by quite a surprise, just given that their bread and butter are these ETFs and, you know, no active management, just pure beta exposure. And now they're adding an element of active management to that in a sense by saying, you know, be a good actor or else. But what does a good actor mean to BlackRock? Is that the same as what it means to you folks? I mean, that's some of the questions that we're sort of struggling with internally, and now we're going to address that if it comes to that point. So, an ever-evolving space. If you look at, just looking at slide 48 real quick, this is just a picture of Callan's ESG committee. We have put together folks from all different parts of the firm to kind of approach this topic from a fund sponsor consultant perspective. So what are our clients doing? The research perspective. So my role in India Seri are kind of heading up that effort, who actually coincidentally worked at CalSTRS when they divested from tobacco in the late 90s.
Oh, really?
So he has a real insider's perspective on that as well. And as well as our database group, you know, looking at, you know, the different types of data that are out there and how it's being used and implemented, all the way to our reporting group, you know, how are we implementing this with client reporting and how are we measuring what's happening in those portfolios? So we think this gives us the best view from all different angles onto how the space is evolving and how we can best sort of push that through to clients and have kind of our best research put forward.
How can you have an ESG committee with only 2 women on it?
Well, I don't have a great answer for that other than these are all the folks that raised our hands when it was time to form the committee.
And I think that's, you know, that's a part of the problem, and that's the whole field of governance. Women are not equally or even, you know, to a fairly decent level in finance all that much. I know that's changing a little bit, but my question would be then, these are people who raise their hands versus how much is the whole idea of good governance and diversity really lived at Callan?
You know, that's a great point, and we will change our ESG committee. Let me tell you a little bit about Callan, though.
Okay.
I manage our San Francisco office.
Mhm.
We have 5 offices. And I'm the only man that manages an office at Callan. All the other are women. Half of our executive committee, our management committee,
Uh-huh.
are female. And our shareholder distribution is very equally split between men and women. So I think we've got the gender thing down
Yeah.
very well. We do a lot of work with ethnic diversity as well.
Mhm.
We have a profound outreach program for women, minority, and disabled-owned organizations.
Mhm.
We have a whole different committee and process for that. And a lot of our public funds are really interested in that, and some of our corporate funds are. So we've done a lot of work on that research and outreach effort.
Mhm.
Admittedly, within Callan, we'd love to be more diverse from a race perspective.
Yeah.
And we work very hard to hire more minorities.
Mhm.
And I think we're very well populated in, I think our population looks very similar to the regions in which we have offices. But I think we could do a little bit better in the minorities, for hiring more minorities at Callan.
Which
But I tell you what,
everybody has to do.
I think we've actually done very well in the male-female thing,
That's cool.
okay?
That's.
But, you know what, no one's ever brought that up to me, because I always come to from the perspective that we have more female managers than male managers at
Mhm.
Callan. But I think that's a great point, I think we should
That's
probably
really a
update this.
softball.
Yeah, there you go.
Great answer.
There you
It
go.
really is, yeah,
Okay.
that's wonderful.
I would say that's actually kind of a good analogy too for ESG, in that there could be some window dressing, but what's underneath may be very different.
Yeah.
And that's the challenge we face in evaluating both what investment managers are doing, but also what the data is telling us and what the information that's out there. Because as you see, I think Greg and I are probably biased, but I think Callan is very forward about promoting and having women in seats of power, and they are throughout the firm. And so I
That's
don't
good.
see that. I look at that now and I'm like, wow, that is the first time someone's brought that up. But that's something we can be more inclusive on going forward. As we kind of continue our discussion, if you just go to page 50, this is kind of what encompasses all the terminology in ESG. ESG is the broadest umbrella term, but as you can see, there's socially responsible investing, sustainability themed investing, and impact investing. And these are all just different points on a spectrum that are all kind of related to this broad umbrella of ESG. Socially responsible investing to us is kind of ethics based. So you're really applying a negative screen, as we mentioned, no fossil fuels, no Iranian exposure, that sort of thing. Sustainability themed investing is kind of trying to look at a company or an investment and say, I really want you to be kind of working towards a sustainability goal, be it resource utilization or less pollution, but I also want a financial return. And finally, impact investing is, a return would be great, but I really want you to invest this money in something that's going to have a long-term positive impact on the community, the environment, whatever the case may be. So financial return is less important so much as you're investing to make a difference in the community that's less tangible to measure. So a lot of impact investing is happening in kind of endowment and foundation space, but as well as private equity, where there's more discretion with what to do with the capital. Moving on to slide 51, just ESG is not a new concept. This has been around for hundreds of years, dating back to, different religions and avoiding, sin stocks, or even Islam avoiding usury or interest. So there's been morals and values-based investing going on for hundreds of years. We've really seen an uptick in the United States starting in the 1970s, coming out of the Vietnam War, and certain folks protesting, the investment in DuPont, the maker of Agent Orange, and some of these other chemicals that became more part of the social consciousness. That evolved through the 80s, through apartheid and people avoiding investment in South Africa until they abolished apartheid, through the 90s and in the 2000s, we have these other corporate events that happen that cause social awareness. You may remember the Exxon Valdez oil spill was a major environmental event, or some of these others like Enron and corporate governance, the internal scandal with Tyco. So people really looking and saying, is there more than financial returns that we need to be focused on? Is sort of the soul of the company as important as the return potential? And I think that's what's really driven this beyond negative screening to Lee's point earlier of having more engagement in proxy voting and trying to work with companies to become better. And we've just sort of highlighted, if you skip ahead to 53, just kind of a timeline, a visual representation of what we sort of just mentioned about how long it's been around. I think the really important slide that I like to show is slide 55. This is kind of a visual representation of that spectrum and sort of the different range of goals and outcomes. Starting with, on the far left, you have traditional investing, where your goal is just to maximize your financial return, regardless of what you're invested in. And on the very far right, it's just pure philanthropy. You have no expectation of a financial return, you're just giving your money to a cause you believe in. And this is why we view it as a spectrum, because you can fit in sort of your goals anywhere along here and still be considered, quote, ESG. So I think that's the difficulty over time that we have with a lot of clients, is figuring out where exactly you want to be on this spectrum. Now we're going to move on kind of from definition and timeline of ESG, just talk a little bit about what other asset owners are doing. So if we turn to page 57, this section is a broad, high-level overview of the Callan ESG survey. So we've been conducting this survey with asset owners starting, I think, in 2013. And we send it to both clients and non-clients across the industry. It's anonymized, they can respond back with the different data points. And so we get a real look through into both what different types of plans are doing, what different sizes of plans are doing, and the different motivations for implementing and not implementing ESG are across the spectrum. So just looking at slide 57, overall across the whole survey in 2017, 37% of our survey respondents and asset owners had said yes, they are implementing ESG factors into their investment decisions in some way. And I think the interesting thing to note is if you look at the table right below, that's up from 22% when we first started the survey in 2013. So this is a space where people's opinions and views are either changing or they're just becoming more aware of what's out in the space. But it's still not a majority of plans, which I think is the other takeaway. It's only essentially 1/3 to almost 40% now. So we're still in the early stages of this being a kind of a broad movement for all plans, or I guess best practice in some regard. If we dig in on slide 58, we go into a little bit more detail about what different types of plans are doing and who is implemented. And as you can see, public plans on the far left of that top bar chart, about 35% have implemented some form of ESG into their plan. This is below the foundations and endowments at 56%, but that's sort of within our expectations. And if you look at the fund types over the last 5 years, you also see that public plans have increased from just 15% of respondents saying they've implemented in 2013 to, as I just mentioned, 35% in our most recent survey. So it's certainly something that's becoming more of a topic of interest and something that boards are looking at implementing. If we move on to page 59, talk about reasons why respondents are incorporating ESG factors and reasons for implementation and how they're implementing. And the number one way plans are implementing is by adding IPS language or belief statement to the plan documents. So this is really a way to both signal to the underlying beneficiaries and constituents that they're taking action, as well as to investment managers that they are utilizing, that this is something that they care about and want them to also care about. If you look at slide 60 on the next page, it's just more of a graphical representation of how funds are implementing. As I mentioned, the top two are both adding language as well as communicating to investment managers what they're doing. You can see there's a whole host of responses as to why and how they're implementing. Moving on to slide 61, this slide is illustrating reasons for incorporating ESG factors for respondents across the survey. And of the respondents, the majority responded that they wanted to incorporate ESG factors as part of their fiduciary responsibility. But as you can see, as we break it down by plan type, the top rationale for public plans was that the fund's investment policy statement dictates that they consider ESG factors, so it's already baked in, or they expect it to achieve an improved risk profile. Interestingly, if you look at the other section, the 32% doesn't tell you a lot, but the main, on the sidebar it says other responses, participants desire to incorporate. That's one of the top reasons that our corporate defined contribution, defined benefit plans have implemented, is that employees have asked them, hey, we want some type of investment or fund that we can look at and be able to allocate our dollars to in the 401k plan or retirement plan that they're being offered. But interestingly, not a lot of our public plans are getting pressure in this survey from their underlying constituents. But as you guys noted, there's huge outliers where you have, the Stanford folks coming in and trying to persuade the board, or you have people at University of California system really, pounding the table. But I think we're also, California and to some extent the East Coast are very different than what's happening at some of our clients in different regions of the US, particularly like the Southeast, the Midwest, and different areas in Texas. It's just a very different discussion based on both the tax base that are paying into the corporate coffers, as well as the type of folks that are investing in some of these endowments and foundations. So it really kind of has a regional basis, but also different plan types have very different goals and outcomes right now. If you look at slide 62, this is one of the interesting slides given, most of our respondents are not incorporating ESG at this time, and this is really highlighting why they haven't taken it into consideration or implemented yet. And interestingly, for public plans, I think you look at the third response down was the top reason, is that they have not seen ample research tying ESG factors to outperformance. And that's really the crux of this kind of ESG debate right now with investment management is, that's great, we want to do well, and it's called, sort of nicknamed double bottom line, doing good by doing well, or doing well by doing good, one of those. But essentially, you can have your cake and eat it too, or so, the optimist would say, but as of now, there's research that's inconclusive as to exactly, what the long-term value proposition is, and it really comes down to a lot of beliefs. And there's a ton of academic research, and we can sort of touch on this later, citing that at the individual company level, there is some added value at looking at different materiality of underlying factors that are going to drive company performance. Looking at resource utilization, how much they do pollute, how they're recycling. And at the company level, it's been shown that yes, unequivocally, it is value add to be in doing best practices to improve those factors. But as we look at it from our perspective, which is at kind of the portfolio level, it is a little more inconclusive because you have so many inputs. And so we have we'll get into the kind of the research at the end, but they're actually good case studies because there are some investment managers that have just their regular way portfolio, and then they have an ESG portfolio. and they're otherwise identically managed, but they have, as you'll see, some different results, which is kind of interesting. But bottom line, I think it's interesting that really the research is driving kind of the results, and we're in the early stages, so I think more research will come. We're also in a very interesting market environment, which I'll touch on later, but you know, as Greg has mentioned, 10-year returns have looked very rosy, and it's a liquidity-rich environment. So how does that impact sort of ESG factors? And that's sort of no one really knows at this point because it's impossible to kind of look forward on that. If we just move on to the next section, we'll touch on a little bit of what investment managers are doing and sort of investment manager activity. One piece of the ESG puzzle on page 64, and you may have heard of, is the principles of responsible investing. These were standards and principles set out in 2006 and established by the United Nations, but they had signatories who are a part of the UNPRI commit to 6 principles going forward. This has seen a huge uptake in interest from asset owners, investment managers, and service providers. And as you can see, that bottom bullet, as of November 2017, 1,850 signatories globally and nearly 70 trillion in assets under management have signed on to this principles statement. You know, they have helped bring this to light across the industry, and actually they were having a meeting in San Francisco at the same time as this, talking about how investment consultants are working with the PRI. So one of our colleagues is attending that right now, so we'll be curious what they bring back. But it's really interesting, but at the same time, it doesn't have a lot of teeth right now. You can sort of rate, and this is as we get into the discussion of greenwashing, you could say, hey, you know, I'm a UN PRI signatory, and you know, we really are looking at this strongly, but they don't have an enforcement function. So it's like just saying like, oh, do you guys believe in doing good for the world? And they're like, yeah, I do. It's like, okay, great. And it's a little more involved with that, but there's not a lot of enforcement function to say, are you really doing each of these 6 principles? And so that's something we're watching, and they're working on pretty, that's something that the PRI has worked on over time to be better at, but they just don't have the resources to monitor 1,850 organizations. And there's a lot of reporting requirements that they have to kind of look through. As we sort of move on, if you look at page 65, how are investment managers looking at ESG in terms of their analysis? This is kind of a sample framework of, you know, how they look at both a company and a stock and sort of evaluate, you know, is this a positive ESG type company that we want to invest in? And I won't bore you with the details, but they are looking at it from a lot of different perspectives, including, you know, economically, is this something that's going to benefit from long-term GDP or global GDP growth? You know, the industry, are they kind of a laggard in the industry? Are they a leader? Is it, you know, a company under transformation? Or are they, you know, already at kind of the top of the heap? You know, does the board, from a company level, does the board care about ESG strategy or resource utilization? Financial reporting, do they include line items indicating that they are doing ESG type activities? Are they disclosing all of the voluntary disclosures that are out there, or just the mandatory ones? And finally, valuation-wise, is that having an impact on the long-term prospects of that company? And does it make it a good value, a good investment, or is it just more window dressing? So these are all things that investment managers are taking into consideration as they build portfolios for ESG type portfolios. And if we look, if we just skip ahead real quick to page 67, this kind of chart illustrates really the level of ESG integration that has occurred within different asset classes. So as you can see on the far left, hedge funds have had a low implementation of ESG type practices and looking at ESG type stocks for their portfolios, which may tell you something, right? These hedge funds are always about kind of, quote, edge or easy money. And so if there was an edge to be had, perhaps more hedge funds would be looking and oriented towards ESG type companies. As you go across the spectrum, you can see public U.S. equity and fixed income. There are some managers as a percentage of the whole universe who have implemented, but primarily when we look at ESG type strategies, it's global public non-U.S. companies, so international equity type strategies. And that fits with where ESG has evolved. Europe and Australia, and to some respects Asia, have been implementing and looking at ESG type factors much longer than the US has from an investment perspective. And a lot of them, it's both baked into kind of their culture, but also something that they have taken as a priority within their investment management. The US has been slow to uptake, but it's also, the US is much more fragmented than some of these countries that have, a single superannuation fund in Australia, or, one Dutch pension fund. So it's not quite an apples to apples comparison, but that is something that we've seen, is that European-based investment managers are much more inclined to have already incorporated ESG type factors into their investment analysis than a standard US investment manager who focuses on US equities. Last section, as we skip ahead, we're just looking at some of the ESG research that Callan has done and also that's out in the industry. So if we skip ahead to page 69, one thing that Callan is tasked with, and particularly manager research, myself and Andy Asseri, who covers international, and Nate Wong, who covers fixed income from the ESG perspective, is really sussing out, which investment managers are out there truly talking the talk and walking the walk, versus those thinking that this is just kind of a marketing opportunity and we can kind of dress up an existing strategy or rebrand it as an ESG strategy. And while they may have some data and analysis that they're, quote, utilizing, it may not be exactly, the best of intentions. And so we've sort of noticed this greenwashing over the last 5 years. As you can see, the survey, there's a big pickup in implementation, and so that's seen as an opportunity by investment managers to offer more products. And part of that is saying, hey, look, we've now taken on ESG data, and we really want to show you that we're incorporating this and analyzing these factors and putting it in our portfolio. Oh, boy, geez, I just noticed that one of your public fund clients is looking at potentially using ESG. What a coincidence. So we've had a lot of meetings like that, and Andy and I, meet on a fairly regular basis to just chat about which managers are out there and what they're doing and who we really like with these different perspectives. I think the one thing that we've found is that there's two sides of the ESG investment manager universe. Lee was sort of touching on this earlier with board implementation, but there's the first, which is kind of a statistical factor ESG implementation. So for example, MSCI is a huge data provider, and they have been one of the big proponents of using ESG factors to measure your impact in a portfolio. And so they have all these factors that they have for each company in each category. So E has all these sub-factors, S has all these sub-factors, and G has all these sub-factors. And they roll it up into an E score, an S score, and a G score. And then they roll it up into a total ESG portfolio score for each company that you have in a portfolio. And what this score tells you, is essentially relative to other companies in their industry, are they a better ESG company with a higher score or a lower score? And it's, taken with huge grains of salt, because it's all based on their analysis and what they indicate is important and material. So how does this relate to the investment management side? Well, a lot of quantitative and factor type managers are saying, okay, great, we can just plug in these ESG scores, can kind of run it through our filter, and now we're looking at all of these ESG companies with an ESG statistical factor. So that's one set of the universe is saying, okay, look, we're sort of overweighted to G, we're underweighted to S, and that's part of this other factors where we're looking at price to book and price to earnings, and sort of rolls up into this big portfolio, and you can say, I want really, kind of an S portfolio or a G portfolio. And even Vanguard has, kind of an underlying index that focuses on that. The Vanguard Social Index is focusing on the S. And it tracks an underlying index, the FTSE 4 Good index, that has rolled up some of these scores into their underlying weightings. So Vanguard's just merely tracking it, but that underlying index has a whole methodology based on this quantitative approach. The other side of the universe is saying, okay, let's do this from a bottom-up analysis. What are these companies doing? Are they positioning themselves to do well in kind of the changing world? Are they taking money that used to be invested in kind of fossil fuels and be investing in renewable energy and positioning themselves that way? Or are they, making changes at the underlying company level to utilize resources more effectively, which will help the bottom line? And are they recycling and effectively moving forward with their prospects? So I think that bottom up plus that quantitative are kind of the two ways that the universe is coming together. And so that's kind of the divide that we're looking at with different investment managers. Sort of in the interest of time, I think one of the last things I can kind of touch on, if you look at slide 76, I mentioned that it's really tough to kind of suss out, what is sort of the efficacy of some of these strategies. And you can look at these cumulative returns for different ESG strategies that we have in our universe and see that from the bottom of the market in early 2009 to now on the top chart, there's only a couple, or there's one that has really generated an excess return relative to the S&P 500 in the US. If you look at the bottom chart on a global basis, it's a little more positive and there's more strategies that have outperformed. But, and I think this chart's a little more telling on kind of the murkiness of the universe. Page 77, this is what I mentioned earlier, where there's strategies out there that have both a regular way and an ESG or sustainability type strategy. And we sort of paired these on the chart and compared the performance to one another. And as you can see, in most cases, the non-ESG version has outperformed the ESG version. But as I mentioned, it's early innings and we don't know exactly if this was all driven just by kind of the markets that we've been in with high increased liquidity, or if it's something that is a part, are you taking a penalty for being invested in ESG? I mean, it's a long discussion, and as I mentioned, we're early innings, the data is becoming better and better every day, but, the jury's still out on a conclusive, understanding of, this is gonna be like the silver bullet, and this factor, and this weight. We just don't know those things yet, and, Callan is, trying to take a very nuanced approach and a data-driven approach. And so we don't have strong conclusions, but we do know that this is an area of interest for our clients and something that we're going to continue to invest resources on going forward. I think that's my, day-long ESG presentation in 30, 40 minutes, but.
Very good.
So, a couple observations I have is that the way you're set up right now is you have a policy statement which doesn't mention ESG. And then you invest in funds. You don't have separate accounts. So you can't even go to the managers and tell them invest this way or invest that way. The way you're set up now is you put your money in a fund, and that fund has its own governing documents independent of what you tell them to do anyway. So there aren't a lot of levers for you to pull to actually implement anything here. In theory, you could go out, you could say in your investment policy statement, we think ESG is important, and we hope our managers look at that. But within actually the security level, you don't hold any individual securities. They're all in funds, so you don't have that lever to pull anyway. You could hire a manager that says, yes, I do ESG. But that would be one manager among many. And it would just manage, it would just be one part of the portfolio. So I don't know if it would, that might be a bit of greenwashing, frankly, if you would do that. So what sort of questions do you have on the topic?
In terms of funds our size, what have you guys seen other people do? Public funds, smaller, like our county? Is anyone doing anything in this field right now? ESG in terms of changing policy or trying to take action?
I think we have our survey results, and I think the full survey breaks it down more by plan size. I don't have that with us today, but I think the bigger plans have taken more action, just because, as Greg mentioned, there's more ability to control. If you're investing in funds, you don't have that lever. But as you go bigger and you go into more separate accounts and customized approach, you can have more influence on what's happening. So I think at the lower end, less from an individual control perspective, but people are implementing belief statements and investment policy statements as a first step to say to potential investment managers, hey, we're interested, we want your investment philosophy to reflect ours, and so this is important to us, we want it to be important to you as well.
So when I think of environmental sustainability, I also think of eliminating waste and just wasting resources. And so like examples of that for the county of Mendocino as a little corporation, you could say.
Yep.
Some recent examples of that would be, not watering the decorative grass 7 days a week, so that which you're paying a utility for the water, and you're paying a public works person to mow the grass 3 days a week. I mean, just ending that wasteful practice saves money. Eliminate or replacing outdated air conditioning units, so you have a more efficient, conditioning, heating and cooling system for your buildings, eliminates waste, and it saves money over time. So, I don't know, I think that's, it's just good business sense, really, as much as anything. And so what are some options that organizations have to sort of join with other entities to say, we don't believe in waste, and we want to see environmentally sustainable practices by your corporation. It's not the same thing as divesting, but it's just saying this is a belief that we have because we believe in the long run it's stabilizing your expenses. If there's a spike in fuel prices, you're immune from it because you've minimized your fuel costs.
Yeah, this is interesting. I don't know specific kind of organization. I think they're out there. I mean, the UNPRI is in a sense part of that, where you have these principles, but specific to that, I think it's almost like voting a proxy and saying, I want you, here's a proposal, I want you to sort of focus on, becoming more streamlined. But to your point, it is just good business sense in a lot of regards. And one area we have seen a lot of efficacy with ESG is LEED building certification. Mm-hmm. So a platinum LEED certified building, actually there's evidence that it has a higher net operating income and cap rate than a non-LEED platinum certified. And it's actually kind of a step function like gold, silver, platinum, higher returns on each step up the ladder. And so I think that's, kind of a niche example within the real estate realm, but overall, I think just expressing those views via proxy is the best approach. And I don't know an organization offhand really that counties could join with to say, hey, this is what we're doing, but it might something to look into. I don't know if you've heard of something great.
I haven't, but I do. If you think about it, your active managers, they also want the companies they invest in to be efficient and have low costs, stable costs. So when they analyze a company, do I want to invest in them or not? Most of them take, at least knowledge of their cost base and the stability of their cost base into consideration when they want to invest in that company. The income or growth of the company they invest in might counterbalance the fact that they aren't always sustainable. But I think most investors now are, most of your managers you work with are knowledgeable about these factors when they're deciding whether or not to invest in the company on behalf of the county.
Well, I think of one other situation, again, a big plan. But when my second confirmation hearing came up, should have been a sail through, the first one was.
Yeah.
And Don Parada turns to Alex Padilla and says, I think you wanted to chat with Ms. Harris before we confirm her or before we vote to confirm her. And I was blindsided, as were, the staff person from Cal RTA and Jack Enos, our CEO, and Padilla informed me that my prospective vote on cigarettes had to go a particular way. And I told him, I don't know how I'm going to vote until I hear the discussion. I mean, it kept coming back and coming back and coming back to staff will bring us more information from the board, because they didn't want to bite the bullet. And I did say, I think we should make a decision on this. And apparently the way I said it came down that I was in favor of cigarettes. And nothing could be further from the truth. But as a fiduciary, I felt the only thing I could vote on was whether the portfolio and the members benefited or were detrimental, in a detrimental situation, or that it was somewhere in the middle. So he held up my confirmation literally until the last day of the session. And they closed once and everybody went home, and then everyone came back again to vote the last pieces of the budget. And John Parada apparently told Padilla that 3 members on the board were voting in favor of my confirmation, and possibly a 4th, even if Padilla was going to vote no. And with that, the vote became unanimous. But that was holding up a board position. And under different circumstances, I suppose the board of supervisors could be pressured into putting someone on the board who thought in a particular way, environmentally or socially or governance. And I do believe that there were some indications that having a more diverse board, ethnically and gender-wise, does result in better returns. Now, maybe not a lot, but, and often the big plans take certain positions, and repeatedly I had people say to me, I'm so glad CalSTRS did this, because, we're small, but we can follow suit and do this. And so I'd be real interested in not making a big deal out of it, but just to see what the other 37 Act plans are doing, particularly LA, or, the big ones. Because we could, if it was something that the board felt strongly about, we could possibly follow suit.
Stan raised his hand, then Sherry.
Yeah, Jerry, you kind of mentioned it a little bit about fiduciary duty. Is it consistent with this board to, the board's fiduciary duty to consider ESG factors, and maybe Callan can, is there consensus on that now, or what are the thoughts around ESG and fiduciary duty?
Is that a legal question?
So I think it's certainly at least in part a legal question, and I think that I haven't researched it. In fact, as I was sitting here, I was kind of emailing my counterparts to see what other 37X systems are doing. I think that there is the ability for a public pension plan board to take some steps toward this in some fashion, whether it's having it in a policy statement, but the bottom line at the end of the day is your returns. And if you're sacrificing your return, then that's going to be inconsistent with your fiduciary duty. But I think that there probably are steps for a board that wanted to try to move in that direction. My guess is that there are some things that could be done. And I think I'll leave it at that for today.
Sherry, actually, Sherry, raise your hand.
I was just thinking that, because you said basically that we're too small to actually move the lever anyway, on this, it almost feels like what I do with the treasury portfolios, because I have mandates that I have to do, safety, liquidity, and yield, that's mandated, I have to do that. But what I can do is look at something, and if all's created equal, I could pick something, maybe I could pick, a different bank than say maybe Wells Fargo or whatever. I mean, I have a little bit of discretion there, and it almost feels like where we may have decisions would be, when we're picking the managers, that would be maybe something we would look at, is how they look at this entity, or this whole discussion, how they look at it, and then we would pick the one that maybe is more in line with how we believe. But it almost feels like that's kind of where we're at, because we're too small maybe to.
You're not gonna have your own policy
Yeah.
and, screen companies out and you wanna give that to other fiduciaries to do that work for you. But yeah, to your point, when we're doing due diligence for you on managers, we can bring back information that says, how do they look at ESG? And that could be a factor that you consider when you're evaluating whether the manager has appropriate risk controls in the way they do due diligence on their portfolio companies.
Can I suggest we avoid what I kind of call the Sebastopol syndrome, where a town of 3,000 people decides that they have to have a policy on the Ukraine and on plastic straws and the homeless in New York State. It's just like, we're sitting here on the sidelines and glad to see that all these other pension plans and public and private are doing something, that management is changing. The world we live in is changing. And those who are old enough to know, this is not our grandparents' world that we live in. And things are changing, and sometimes just sitting on the bench and watching it change is just good enough, and get on with what we do and not try to change the world. Thanks for the report on the topic.
Yeah, and so to be clear, this is an educational session, and it was requested that we bring the topic to you, so I don't want you to come away with the impression that we're advocating for it. But if you do have an interest in finding a way to incorporate this some way in your plan, we have the resources and ability to do it for you. I have some of my investors do some things with ESG, and some of my investors that I work with don't. And it really comes down to where they sit in their view of the world. And everyone has a different view of the world and has a different definition of what ESG is. And some mission-based organizations are very passionate about it, and others not so much. So
It's very important that we know and understand the topic.
yeah,
Whether we have to take action on it,
yeah.
yes or no, that's whatever the board decides, but
Right.
it is important that we understand the
Yep.
topic and realize it's important in the big picture.
Particularly in this community.
Right.
Jerry, do you have anything else?
And that's exactly the right response, I think, at this point. I don't want to see us have to deal with a group that comes in and, very strongly advocates for their position. I want to know that we have something we can say about our fiduciary obligation, because that is what it's all about. And, James, I want to know that, that you can advise or can lead us to a position where we're not just overwhelmed with what a group of kids say. So I'm sort of punting to you.
So if I may, Mr. Chairman, we've worked very diligently as a board that to put ourselves in a position and always stake out that this board does not make decisions off the cuff. It's always going to be a policy approach. And if we had a bunch of people come in and demand that we do something or not do something, my position and my recommendation will always be to this board, listen to that, let's hear it, then give direction to staff, legal counsel, investment consultant, whoever, to go research the topic, gather the facts and the information, and bring a recommendation for a policy to this board. And that will always continue to be my position, is that this board needs to govern by policy, not by snap decisions. So I will always make that recommendation if someone comes in, whether they're suggesting that we do something or we not do something, either way. And there are things that we hear from the other side, you guys should be doing this. I have the same answer. We will, if the board directs us to do so, we will research that, put together a proposal and bring it to the board, and then get further direction from the board to put a policy in place.
And hopefully the Board of Supervisors would not yield to pressure of constituents in our community to put someone on the board who thinks a particular way.
Hasn't happened so far.
No, don't want to react when it does.
Chair Gibson.
Yeah, and I just agree with what Lee's saying. I hate to see a policy for everything, like even to add, like I have one paragraph that big in my investment policy, for the county treasury, and that has satisfied the people that have come forward. I absolutely listen to them, and I do look at that. It's not my main thing that I look at, but I do, if all is created equal, I will look at that, and I think that they appreciated just having that awareness and just basically encouraged to look at that and have it evaluated. So I think everybody's on the right page, really.
Yeah, over the years, I think we've had some members of the Board of Supervisors and some of the community that want us to invest in real estate in Mendocino County to make homes available to whoever might want it. And I've been asked that many times since I've been on the board, why don't you people do that? And nobody's ever come to the board and asked us to do it, but they do out in the community.
I think we've concluded the presentation.
Okay, great.
Thank you so much.
James,
We're not done.
James, you have something else? Oh, we still have a couple other.
Yeah, performance, right. So we're done with the ESG. We'll flip ahead to performance, and you know what? This should be pretty quick because the story's pretty good and there aren't a lot of problems to talk about. So this is a separate presentation. This is our standard performance report. And when I talked about the capital markets, I noted that returns for the last year across almost every asset class has been very, very strong. And when we look at the performance report here, you'll see that. And the fourth quarter was a strong returning period as well. I'm going to flip ahead to page 8 of the performance report.
Is this the quarterly or monthly?
Quarterly, thank you. And on page 8, this is the first chart we normally look at. And here we ask the question, is my actual allocation at the end of the year close to my policy target? And the answer is yes. You're very close. You're within any rebalancing range. But the run-up in the stock market has continued, and bonds have gone up, but they just never go up and down as much as stocks. So you're a little underweight fixed income, and you're a little underweight real estate, and you're a little overweight U.S. stocks and international stocks. So I know Stan and James have been doing some rebalancing in the quarter, but this is the sort of thing it's like sweeping the ocean where, it keeps coming. And so you're a little overweight risk assets, again, relative to your policy target. On page 9, we look at the assets, and the bottom line at the end of the year, you stood at $520 million, and the fund increased by about $17 million, and it was due to about $19.5 million in investment gains, and $2.8 million went out for benefit payments. Okay. If you look at this list here, you'll see that Stan was doing some work in rebalancing the portfolio and defunding a couple of our managers. Recall, we did an asset allocation study, and then we went through each asset class and decided how we want to change it. We made the decision to simplify the large cap equity allocation and add a equal weighted S&P 500 index fund. So you'll see in this past quarter, we redeemed from Janus Research and Dodge & Cox Stock Fund, and you funded the S&P equal weighted index fund. So that was just implementing decisions you had made before. Looking at returns, flipping ahead to page 11, in the quarter, the investment portfolio was up about 3.9%. It lagged the total fund benchmark by about 30 basis points, which was up 4.2%. However, if you look over the last year, 3-year, 5-year, you're outperforming your policy benchmark. For the last year, the total return is a very significant, just shy of 19%. For the last 3 years, you're up 8.25. In the last 5 years, you're up 9.7. For the last 7 years, you're up 8.5, a little bit behind your policy benchmark. So why did you perform the way you did? Well, one, we know capital markets were up and that the beta of the market will determine 90% of the variability of returns. The other component is the managers you decide to invest in, as well as any slight deviations you have from the policy benchmark. And we quantify that on page 14. So that for the quarter, you missed the policy. You had a great return, up 3.9%, but you missed the policy benchmark net of fees by about 30 basis points. And the big culprit, the big drag, was your international equity managers. And in particular, you have a couple value-oriented managers, Mondrian being one, who has lagged the broad market. And we have seen that value managers in international equity in particular have had a really hard time keeping up with the market. This would be the worst time to change courses in midstream, right? Because they are lagging the market because they're buying more defensive or yield-oriented strategies. But that has been the headwind for the quarter. All right, well, we know that longer-term performance is better. Let's look at the last year. For the last year, I mentioned you're up about 18.9%. You're beating your benchmark by about 1.5% for the last year. Your U.S. equity managers did great. They added about 1% to the bottom line. Your bond managers added about 30 basis points to the bottom line. Your international equity managers in aggregate actually added about 4 basis points. And your domestic real estate managers were essentially flat versus the index. So for the year, very strong returns in absolute and relative terms. So very good report card. Over the last 5 years, on page 19, you'll see that you've added about 20 basis points per annum net of fees. And slight deviations from the benchmark added a little bit. And then also the equity and fixed income managers were in particularly strong performers for you. So pretty good story overall, performance-wise. If we flip to page 19, we have your performance relative to other public funds and the benchmark. You're the green dot, the triangle's the benchmark, and then the floating bars are other public funds. And you'll see here you're ranking pretty darn well relative to other funds across all time periods. And over most time periods, you're a little bit ahead of that little triangle. So, pretty good report card. We know that, and we've talked about that, I try to say it at almost every meeting, you tend to outperform in strong equity markets, you tend to underperform in bad equity markets. You're only invested, except for real estate, which is 11%, you're invested in public markets. Other public funds have other things out there too. And that means they don't run up as much when the stock market's high. They don't fall as much when the stock market's low. Okay? So right now, over the last year, it's been an awesome stock market, and you're ranked in the 5th percentile. You're better than 95% of other funds over the last year. But that's because of the way you invest, right? So I say that because if the story changes, your ranking's going to change. And we've seen that over fiscal calendar years. If you look at page 21, in 2016, where international equity markets in particular had a tough run, you didn't rank well, but in calendar, in the last year, you did rank in the top 5th percentile. We need to fix these fiscal year numbers a little bit. The way we're portraying is a little confusing, but the big takeaway I want you to come from here is that when the stock market's going well, you do really well relative to peers. When it's not doing well, you don't do as well. Okay? I'll flip ahead just to a few charts here. On page 23, here we look at your aggregate domestic equity portfolio. So you take all of your domestic equity funds you invest in, and we ask the question, how have you done? Punchline is, it's done pretty well. And you've done better than most other public fund domestic equity portfolios have done. You have more in active management than a lot of other investors, and your active managers really paid off for you. So that's been a pretty good story overall. You have a slight growth orientation, and you have a bit of an overweight to technology. Let's look at international equity, and that's been a tougher slog for this portfolio. Recall we had that Janus Overseas Fund. I'm on page 49 now. And that Janus Overseas Fund left a mark on our portfolio. But since then, we've done okay. We've kept up with the broad market. In the last year, it was up, the international equity composite was up about 28%. So pretty strong returns, and the broad market was up about 28%. So you outperformed by almost 1% for the last year. The last quarter wasn't too good for you, but the 1 quarter record does not make. And I mentioned that a good chunk of this had to do with the value-oriented managers. Okay, on page 79, we take a look at your broad fixed income portfolio. So this is where you combine Dodge and Cox and PIMCO. And your performance here has been above the index. Most active fixed income managers have done a really good job of beating the benchmark of late, and that's portrayed on this chart as well. So for the last year, your managers outperformed by about 1.2%. Underperformed a little bit in the quarter by about 10 basis points, but overall longer time periods is quite strong. You see this dot is above the triangle over all time periods, so pretty good. So, Lee, you mentioned earlier about shortening duration. If you look at page 81, here's where we look at the aggregate characteristics of your underlying fixed income portfolio. And this index, the Bloomberg Barclays Aggregate Index, has a duration of about 6. So that's how much interest rate risk or the average maturity is for the portfolio. Your managers, on average, have a duration of 4. So they're 2 years short of the index right now. So they're expressing a view about interest rates going up. They're expressing it slightly differently from each other. If you look at the Dodge and Cox portfolio, they are just underweight U.S. interest rates. If you look at the PIMCO portfolio, they're actually about average in U.S. interest rates, but they invest in international markets as well, and they're actually short Japanese rates and European rates right now. And that's bringing down your total duration of your portfolio. So what they're kind of saying is, U.S. rates, it's okay, but I really don't like Japan and I really don't like Europe right now, interest rates.
Because they're behind the curve on raising rates?
That's right, and their yields are just a lot lower.
Negative. Are they
Yeah.
still negative?
Some of them, certainly. And that's gonna be really interesting. This is the conundrum that the bond market can't figure out yet, is the Fed says it's gonna increase interest rates, we know the balance sheet is getting smaller. But with our 10-year yield sitting at 3% or 2.9 or whatever it is today, it's still a whole heck of a lot higher than Germany. So all of those other investors across the globe
Yeah.
say, well, why don't I just buy a US Treasury? Right. And so that extra demand could keep a ceiling on how much interest rates increase in the United States. So the last asset class we'll take a look at here is the real estate. And you have two funds here, REEF and then Barings. The REEF fund has performed okay relative to peers, and they're in pretty good standing. Remember a couple years ago, we had some questions about REEF because they went through some personnel changes. But since then, they've done a pretty good job. Last year, they returned about 6.4%. About 2/3 of that is coming from income, and about 1/3 is coming from appreciation. If you go back years, it was more heavily tilted towards appreciation than income. So that cap rate compression is not happening like it was before. Overall, REEF is in pretty good standing. It's about a $12.5 billion fund. It's sitting at about 20% leverage. All these core open-ended real estate funds utilize a little bit of leverage. 20% is signaling that it's kind of low right now. They have a $300 million queue, people wanting to get into the fund. And they had about 100 million redemption requests in the last quarter. So pretty healthy fund, they're doing pretty well. If we look at the Barings fund, the story isn't quite as strong. Their performance has lagged the benchmark. One problem with this benchmark is the benchmark is essentially their peers, right? So they're a little bit behind the average fund out there, as opposed to some investable index fund you can go out and buy. But they're a little bit behind that. The bigger issue with Barings is they had a personnel change where the key PM, Terry Huberin, decided to leave the firm, and they had two new PMs assume her responsibility. And we've met with them, and we think they're pretty good. Their portfolio has been conservatively positioned. We thought Terry would stick this out because she's been saying, the market's getting a little frothy and a little conservative positioned. And she'll be right someday, right? But she kind of left before she was right. We didn't foresee that. And they're not changing a lot of things, but, and we think the team's okay. And we think the assets, it's well diversified, it's got 19% leverage, there's nothing crazy going on in there. But when Terry left, a bunch of investors put in a redemption. So this is a smaller fund, it's about, I think it's $4 billion. I had the numbers written down, but I lost my cheat sheet. It's $4 billion in size, and they currently have a redemption queue of about $200 million. So that $200 million redemption queue is a little more meaningful because it's a smaller fund. Performance hasn't been great, they've had a little bit of personnel turnover. So our point of view now is that we're not pounding the table saying you gotta get rid of this fund, but we think what might be prudent is take a look at other core open-ended real estate funds out there to see, okay, what else is out there, and if we went out of this fund, where would we go? And just to see what are the other possibilities out there. So what we would recommend is that Callan go back, do a little bit of work, take a look at other core open-ended real estate funds, and work with staff to see, okay, is there a better alternative out there? And if we found one, how would we transition to it? Because it's tough. It's not like the public market where you could just sell all the securities and put it in another fund. There's a bit of a transition because they're executes and entrance queues. So our recommendation is just test the market, see what else we have out there. Not necessarily commit to replacing them, but just see what else is out there right now.
Quick question, you mentioned personnel changes there. Have things settled down at PIMCO since, I can't remember.
Bill Rose?
Yeah.
Yeah, so you know what's amazing about that? I don't know how many years ago that is now.
It's 2014.
Is that right? So, I mean,
September
we're
2014.
three and a half years into it. It's been a while. Their assets under management has very much stabilized. They're a healthy organization. Performance has been decent. And we like the PM on that, the total return fund, so we don't have a recommended change. They were on a watch list for you, and we took them off, it might be a year ago now or something. So, but they continue to do a reasonably good job for you.
When you assess REITs, do you look at their portfolio and put some opinions on the types of real estate that they hold, and perhaps call brokers in those markets and say, hey, by the way, what do you think of ABC Tower? And kind of investigate the types, not only, well, first the types of real estate that they have, and then in their occupancy and their kind of acceptance in their marketplace.
Yeah, so we have a real estate research team. So just like Mark covers equity, we have Sally and Avery manage our real estate team. And they have, I think, 3 other people working with them. And they do the due diligence on the real estate managers. So the way they do that due diligence is very similar to what Mark does, is you look at the organization, are they aligned with you, the people, process, philosophy, performance, all of that stuff. But they also look at the characteristics of the portfolio, and they might gravitate to more larger risk factors like regional diversification and property level diversification. Are they in industrials or office? Are they in the west, the east, northeast? More than actually underwriting an individual property, right? So that would be akin to Mark calling someone and saying, hey, they own this stock. What do you Mark trying to be the equity analyst where he's analyzing individual company. So they won't so much do individual property underwriting. But what they will do is they'll talk to industry contacts they have and say, so tell me, you like Prudential, or tell me what you think about Prudential and the way they invest in properties and their due diligence and how they allocate their capital and the leverage. But not so much, what do you think of 555 California Street?
Is that the one that's sinking?
555 Cal's the old Bank of America building. Yeah. So the only manager we have that we would do a little more work on right now is the Barron Fund, and so we'll go back and do some research to see what other opportunities you have out there.
Good.
Okay, and then the final thing is the monthly report, and so this is the monthly flash report. So at the end of January, before February's volatility, the fund stood at $542 million, up another $20 million. So very strong returns in January. We've seen the market come back since the high in January, but I think we're still above our December 31 values. But today we wouldn't be sitting at $542 million, but we're not back to the $520 million. You'll see here that REEF called another $2.4 million in capital. One thing I didn't mention when we were talking about REEF earlier is that you made a follow-on $6 million commitment about 6 months ago, and they called $4.5 million, so that you have another $1.5 million yet to be called on the REEF portfolio. Performance continues to be strong. So in the month of January, return was about 4.14%. You outperform by about 70 basis points. It's just a month. But if you look here, the 3-month, 12-month, 3-year, and 5-year numbers are all pretty attractive and ahead of the benchmarks. And this kind of goes to something James mentioned earlier, is that endpoint dependency is a very strong thing. The time period in which you're measuring things can change pretty quickly. So for the 3 months ended January, your international equity managers are now ahead of their benchmark by about 30 basis points, up about 9.1 versus 8.9 for the index. So they had a pretty strong month, and so they erased the deficit that they had in the fourth quarter. Overall, very strong report.
Yay.
There you go.
Thank you.
Thank you.
Thank you.
Yeah.
Probably buying some ready for February.
Yeah. I'm long ready.
It was so funny though, as soon as I saw that stock market do that 1,000 points in one day, I thought, oh my God, Greg, because I remember at the last meeting I was at that you were at, I remember you talking about there's no volatility. I don't know what's going on. There's no volatility. And I'm going, there's Greg's volatility. Yeah, and there it is. Yeah.
So it's your fault.
Yeah, he was saying that. He was going, I can't believe this. There is no volatility.
Yeah.
Yeah, it was funny.
Okay, thank you. And we're going to take one more item before we take a break, and we'll see you. We've got another.
It's a non-investment item.
Yeah.
Okay, great.
So they're done?
Thank
Yeah.
you.
We're done. Okay,
Thank
thank
you.
you.
Thank you.
Yeah,
Thank you
thanks.
very much.
Yeah.
Thanks, guys.
Thank you very much.
Before we take another break, we're going to go to item number 4, which is discussion possible action regarding the approval of the annual cost of living COLA as of April 1st.
We'll go this to Tim? Oh.
You want me to make the motion, or do you want to speak?
You have the letter from the actuary trustees. I have nothing further to say.
I move we approve the COLA as recommended by the actuary.
I'll second.
And just in discussion, I told myself I wasn't going to look at the Bay Area all year long. I said, don't look, don't look, don't. I looked. And actually, we're rounding down in the Western Regional, and we would round up in the Bay Area.
That is correct. There is about a 20 basis point difference between the western region being higher than the Bay Area this year. So
Most of it's probably housing.
I did not look at the components, so I cannot address that.
Okay. Any discussion on the motion?
70 cents a gallon gas.
Do we need a roll call vote, or do we just have the all those in favor?
We can, I believe we can do a
Voice vote?
voice vote.
Okay. All those in favor?
Aye.
Any opposed? Okay. So I want to take a 5-minute break before we go to item number 5.
I probably shouldn't miss the opportunity for a break.
I'd like to say that you're definitely winning.
11:31, we'll resume the board meeting and go to item number 5, which is discussion of possible action regarding actuarial practices and funding policy.
Thank you, Mr. Chairman. Trustees, you have the policy with very minor amendments and slight edits to it. I recommend approval as presented, and be happy to answer any questions.
It's pretty minor amendments.
Very.
I recommend approval of whatever this.
There are minor revisions to the retirement administrator performance evaluation.
No, we're on the actuarial practices and funding.
Actuarial practice and funding.
I'll second that.
Okay.
Kathy will second mine.
There we go.
Any discussion on the motion?
Whatever it is.
Whatever.
I knew
Okay.
it was.
Not hearing any discussion on the
Cameras
motion.
are rolling.
I know.
All those in favor?
Aye.
Any opposed? Then we're on to item 6, which is discussion of possible action regarding the retirement administrator performance review policy.
Oh, that's, okay.
Thank you, Mr. Chairman. Trustees, very, very minor corrections here as well. I recommend approval as presented.
Move to approve.
I think I made that motion on the last one. That was
I'll second.
If I
Okay,
remember
got a motion
mixed up.
second.
Get ahead of yourself.
Yeah.
Any discussion on the motion? Not seeing. No. All those in favor?
Aye.
Any opposed? Okay, now we're on to item number 7, which is actuarial scenario analysis project.
Thank you, Mr. Chairman. Trustees, in your materials, you have a memo that I hope you all have had time to review. And this, I'll remind you, is a project coming out of the board offsite meeting where we talked about conducting an analysis of an actuarial analysis of the impact of alternative economic scenarios. I've been around and around with this, looking at a large number of things we could consider and might want to consider, and have come up with a list of alternative economic scenarios that I put before you and would recommend we pursue. The major question for you would be whether we wanted to also look at scenario number 5. That does carry a significantly higher cost than the first 4 scenarios. I'd be happy to answer any questions. And my recommendation to the board is that you decide if you want the 4 or the 5, or if you want to make some changes to the 4 or number 5. Let's figure all that out, and then the board decision, I would also recommend you include a budget amendment in that.
Go ahead.
The consultant is somebody we already engage for something else. We would just adding an additional task to them.
That is correct, yes. This is working with our consulting actuary, Siegel, to conduct the analysis.
And they have given you those quotes of
Yes.
costs.
Yes, ma'am.
So I mean, I'd be interested to find out about number 5, but the cost did concern me, and I'm just wondering if the cost is an additional $5,000, what action would we take? I mean, is there action that we would want to take depending on the answer, or I mean, would there be an immediate consequence to?
So as I stated in the memo here, and I'm trying to find the exact
Purely education.
the board expects the results of this analysis to be purely educational.
Mhm.
I don't believe there will be any actionable information we gain from this, but we will have more information about what alternative economic scenarios means for our actuarial funding status, be that the UAL and the unfunded liability, but also the contribution rates, and we can just have those discussions with plan sponsors and educate them as well as to what those alternative economic scenarios might be.
Question, has anybody else done this?
Absolutely. Sonoma County does a similar analysis every year, looking at primarily scenario 1 and scenario 2. It's a standing part of their annual valuation process that they always look at that. I'm aware of Orange County went through a much larger project in looking at the alternative economic scenarios, where they involved the consulting actuary and the investment consultant. So there's a broad range of options here. We're kind of in between those two, looking at more than just the 0% or double your assumed rate of return, but not the full-on, let's do everything and model it to the nth degree.
Well, I was a big proponent of this, and I guess the question I didn't ask at the time was, has somebody else done this? And if somebody else, like Sonoma County, has a similar portfolio to ours, then what do we gain by spending more money to have our similar portfolio have the similar constraints applied to it?
So
Or stresses?
I will say so the actuary will model the impacts for our system,
Right.
in terms of actuarial valuation metrics, the unfunded liability, the funded ratio, and the contribution rates. They will not look at what this means in terms of our investment portfolio. That's outside of their purview. They're only looking at essentially those three measures of actuarial health. We can take the results from Sonoma County and extrapolate them like this to Mendocino County. But I'm not sure how valid that would be because they're very, very different plans. The benefit structures are entirely different between Sonoma County and Mendocino County.
Is there another county that might be sort of, that you might be aware of?
I'm not aware of another county with similar benefit structures that has also done this type of analysis. Yeah, I'm not aware of any. They may be there, I'm just not aware of them.
I was just looking for a shortcut if there was one.
The timeline on this project is relatively short. The consulting actuary says they should be able to get us results within 60 or 90 days. So.
Jim?
Yeah, I'm confused by number 5 for 2 reasons. When we do the triennial report, when the actuaries do that, they come up with their recommendation for our estimated rate of return. We do that every 3 years. I'm not sure why we would ask them to look at a specific investment rate and do whatever they tell us, whatever they would tell us. Plus, you're saying lower the assumed interest rate, investment rate to 6.5, and the assumed rate of inflation to 2.75. And as I recall, the investment return is a combination of the expected real rate of return on our investments and interest. This looks like, if I looked at this, I would say, well, do we add the 6.5 and the 2 3/4 to come up with our rate of return? Because the real rate of return plus inflation is what we use already, so this is confusing me.
So the assumptions here in scenario number 5 would be lowering the total nominal assumed rate of return from our current 7% assumption to 6.5%, and lowering our assumed rate of inflation from the current 3% down to 2.75. So not only in essence, there's a 25 basis point reduction in the assumed inflation rate and a 25 basis point reduction in the real rate of investment return. And that's how you get from the 7% nominal current to 6.5% nominal proposed here.
So what I'm still confused about is why would we ask the actuaries to do this when they're already do that in our 3-year report when they come back and make a recommendation of what the investment expected rate of return should be?
So all this would be, this is not second guessing the actuary, but this is, there's some forward looking here as well. As we all know, Siegel is very methodical in how they review all of the assumptions, and they have been moving in the direction of lowering the assumed rate of inflation. When we did our experience study a little less than a year ago, they recommended a 3% inflation rate. They are moving in the direction of lowering that assumption further with other clients who have conducted subsequent experience studies. So kind of the early heads up that they're giving us is when they come back with another experience study, they may recommend that we lower our inflation rate assumption from 3 to 2.75. And if we wanted to consider what that would look like, we could do that now well in advance of the experience study to have some additional information. And we could throw in an additional 25 basis point reduction in the real rate of return. If you don't like 6.5, you can choose 6.75. We really don't care. That's what we had talked about, and we can change those numbers to anything you want without affecting the cost. So it's whatever you would like.
Well, once they create the grand formula for this, it seems like whether they use 6 3/4 and 6 1/2 and 6. I mean, they just press the button 3 times because it's all just one factor in a big, long equation.
So the first 4 scenarios are relatively easy to build one after another because they build the model and then they just change inputs.
Right.
The 5th scenario is different because that involves changing assumptions which have to flow through the entire actuarial modeling process rather than just assuming we get a different outcome from the assumptions.
I got you.
Okay?
It's not just a whole number.
Right, right.
Okay.
In general, I'm always in favor of more information. I would like to see more information. I think that would be of interest. I think the concern is the cost. And so I pulled up, the budget report that I knew we were gonna be discussing later, and there seems to be quite a bit of savings in some personnel costs and maintenance and things. So, I mean, I'm not familiar enough with this organization to know what $15,000 does, because it's just a different scale than I'm used to working with. So, I guess I'd like to hear whether that's the major concern from everybody. Is it the money, spending the money on
Not for me.
it? No?
My concern more is if they come back and say, yeah, in 3 years, we're gonna recommend you're down to 6.5%, and somebody out in the community hear that and start showing up and say, do it now, don't wait 3 years. I'd rather wait and get it 3 years from now, or 2 years from now, than to have the information there. It's just me, because I think it might bite us.
Well, I think the part of the thought was, it's giving a heads up, not necessarily that this is going to be adopted or it's going to be recommended by Siegel, but that it is giving people a heads up on what are the magnitude of the costs. So when the county's developing its budget, employees are thinking about how much they have in take-home pay, at least that information's out there that they can maybe see a scenario that may or may not unfold.
And concerned voices out in the community have pointed at that as one of their concerns, that the board has not done shock tests, and rather than just grabbing onto here's our scenario, and it's well, what happens if it doesn't do that? What do you need to be thinking about? So I think that's a valid concern.
Okay, well, someone probably needs to make a motion or give direction.
I move that we proceed with this proposal.
Yes, there's,
Does that
Hire
include,
the consultant to do the shock test for our portfolio.
and that includes number 5?
Yes.
And you also need to then include an amendment to the budget. That's
And,
where I read that.
and amend the budget accordingly. Does that require a separate vote?
I don't think so.
I don't think it does. So if I might clarify, the motion would be to proceed with the alternative economic scenario actuarial analysis, specifically requesting the actuary analyze scenarios 1 through 5 as presented, and that the FY 2018 budget be amended to reflect those additional costs of $15,000.
Precisely.
Exactly what
so
we
moved.
You know what I said?
Exactly.
0 through 5?
1 through 5. Zero's included because it's the baseline.
I'm gonna work it.
Okay, there was a motion and second. Any more discussion on that? I heard Jerry second.
Yeah.
Any other discussion?
Did I?
You said so moved.
Oh, yeah, just,
Oh.
You were joking.
we can't discuss without a second, so I thought someone else, we've been discussing, so I thought someone else had seconded.
I'll second
Okay, there we go.
Okay, sorry. Any discussion? Okay, do we do a roll call vote? No, okay. All those in favor?
Aye.
Any opposed?
I hope it doesn't do what I thought it was gonna do, but go along with getting more information.
Well, I think
Yeah.
information-
If I may, Mr. Chairman, I did talk with the investment consultants about what we should be considering, and I did want to educate the board. You'll notice there's nothing in the scenario list involving increased inflation. And, because there's a concern about inflation coming back at some point. In talking about it with the actuaries, the only way that increased inflation could impact our valuation metrics is if we saw some flow through to total salary. Because, and in talking through that with the actuary, we have a hard time seeing, if inflation went to 5%, we have a hard time seeing that wage growth in Mendocino County would jump to 5%. We already have a wage growth assumption of inflation plus an across-the-board growth of 0.5%, plus a growth factor for merit and promotion increases that ranges from 8% to 0.5%. So our current salary growth assumption ranges between, 4% to 0.5%, ranges between 4 to 8.5%, averaging somewhere in the 4.5 to 5 range, we think. So we have a hard time seeing inflation passing through in Mendocino County because we've seen so many years of salary growth not keeping up with our assumed inflation plus whatever. So if inflation doesn't hit salary, it doesn't affect the actuarial valuation at all. So I just wanted you to be aware that we did consider that, but it doesn't have any impact unless it hits salary growth. So,
Okay.
sorry, I forgot to mention that before we got through there, so.
Okay, and then we're on the quarterly budget update.
Thank you, Mr. Chairman. Trustees, you have the explanation of the budget, the quarterly budget reports. You'll see current quarter or most recent quarter versus same quarter prior year, year-to-date versus last year, and then the same two schedules for budget to actual comparisons. Stan's done a very good job, I think, of explaining most of the variances, but I'd be happy to weigh in if you have any other questions.
I've seen lots of questions. Okay, so thanks for the update. Now we're on to discussion possible action regarding return administrative report, Calipers trustee roundtable.
Thank you, Mr. Chairman. Trustees, there's a number of items listed here. I was asked to get some feedback from trustees as to why you're not going to the Calipers trustee roundtables.
Probably a message in there someplace.
I'd be happy to take any feedback and send it along if you have any. If you don't, that's fine as well.
I'll go with number 3.
On vacation.
Yeah, I'd say mostly number 3.
Okay.
Yeah, I've never been to one.
Well, Callan's event was great.
Their calendars, yeah, they are great.
The 3 of us were there, 4 of us were there.
I mean, isn't
Yeah,
it important
isn't it
that we send?
Crazy
I mean, should we try to make a
quality
bigger
of
effort to
speakers
go to
and-
this? It wasn't high on my priority
I've
list.
been probably 4 or 5 times. This year I couldn't make it. Yeah.
I will say that I put a great deal of effort into attending the administrator roundtables. Because there's a lot of information that I take away from those. But it's my peers that I'm there with. They're running other systems every day, and I get to hear the issues that they're facing, and I get to learn of issues that we should be facing and haven't been. And oftentimes I leave there with a list of, oh my gosh, I have to ask Jeff or staff about this or this or this or this. And then I get back to the office and I was really frantic when I was there, but I realized, okay, we've got these things under control. We do learn things that we do need to work on. If you're comfortable that you're getting everything you need, I don't know how much value there would be in it.
Has anybody attended them? But they must put out agendas before they have their meeting, right?
Did you send us that?
I don't know, well, the agenda gets
Or are they just
constructed
roundtables?
very late, like most roundtables do. Jeff goes to the attorneys' roundtables. Other staff have been to benefits roundtable, disability roundtable, investment and accounting roundtables, communication roundtables. There's a bunch of different avenues for peers to get together and learn. I think it's a great service provided by Calipers for staff. I don't know,
Is it 2 a year, one north and one south?
I think so generally.
So I would encourage at least one person to go for the northern one. And so it's one a year for one person and you can report back. So I would encourage at least one person try to attend the one in Northern California. That seems,
Yeah.
I don't remember
Minimally
getting
reasonable.
notification of when and where they are.
Well, Judy
Judy
has
sent
given
them.
us the printouts at our
It's on
meeting.
the, yeah, it's on
Have
the,
you-
the
I got an
the
email.
quarterly reports, and then I'm enrolled in a notification, so I get an email notification, and I forward that for the trustees roundtable to all of you. You can also request access to the Calipers site. You can visit the Calipers site. You can also register as a member and get on their subscription list and receive email notifications.
I
Have you
think
been
it probably
to?
comes to this.
It goes to both.
It does. I don't remember seeing.
Have you been to over a year?
Not over the years.
Never, that was not anything you ever went?
I've gone to some of their breakouts, what do they call that?
Do they have breakouts at the General Assembly?
The General Assembly,
Okay.
I've gone to a couple of them.
If we go, are we then taking on an additional responsibility as
That's good.
a trustee that we will now be the liaison between Calipers and Sarah?
No.
And,
Absolutely.
and you mentioned you come thinking about all sorts of things that we should be doing and we're not. That concerns me, that we don't even know what we should be doing and we're not. So, I mean, I would go, I probably have, Tim and I as retirees probably have, and Kathy as well, have more latitude because we have, we're retired. So I would be willing to go to the next one as long as it's in the north somewhere. But how do we answer that if we've never been there as far as what we're not doing that we should be? Dear retirement administrator.
I will say you are largely dependent on staff to advise you of what you should be doing if you're not getting information from other sources.
I mean, as fiduciaries, so, all know it's a high standard and
Yeah.
you have the continuing education. I don't know how you're meeting those hours, where you're getting them from, but this seems like one of the better places to get it from.
Okay.
When I went to that Calipers training last year, they spent a lot of time where trustees were talking. It was just interesting hearing how other systems did all their different processes and realizing that even though we're all 1937 Act counties, there are some pretty distinctly different ways that people were approaching issues. So a lot of it, when I was at that one, it seemed like just talking in general conversation led to, you know, sort of new ideas or different material.
If I may, Mr. Chairman, an example from the most recent roundtable that I attended is there was some discussion about new ADA standards for documents on your websites.
You have to have a braille screen.
Everything on your website has to be machine readable. I wasn't even aware of that new requirement that had gone into effect the day before I was at the roundtable. And I came back and, what are we doing on this? Well, it turns out because the county is handling our website for us, and we recently did a migration, they made sure that everything was compliant. It was a concern that I had. I came back, addressed it, asked the question, and it turns out we're fine. But I would not even have known to ask the question had I not learned it from at the roundtable. So,
Well, I'm looking this up, because when you ask why didn't you, I mean, I'm looking at the handout that you gave us. I mean, it's one day for a few hours, and it was in Glendale. Okay, so I'm gonna say location for one, but then I was looking up the next one, and I'm not sure they give you enough time. I mean, it's not.
Sometimes it's not enough time.
Yeah, you didn't put a June one on here, and maybe they just added it, but there is one in Oakland on June 8th. The same day
Okay.
they're having an attorneys roundtable and a benefits roundtable,
Yeah.
but it's a trustees roundtable in Oakland.
That's not enough advance time for you?
Well, that
You're
is.
really booked up, so.
You're gonna get spanked, you know?
It doesn't say what it's about or anything. I mean, it doesn't say what the topics will be.
so
Yeah.
the way the roundtables typically work is there will be a member of the group, in this case a trustee that's put in charge and chairs the meeting. They will solicit topics, ask trustees or whoever to send in information or things they want to talk about
Ahead of time.
They may also arrange for an individual to come in and provide a presentation, some training, if you will. And then, and at the administrators roundtable at least, the agenda is always brief introductions around the room. We start working our way through the list of topics previously presented. And then after that, we go to more of a roundtable presentation of, hey, I thought of this question just yesterday. Does anybody face this, and what do you do about it? So,
When you talk, the less appealing it sounds.
Well, you just book in a hotel room, and there's probably a 10, I don't know what the cancellation policy is, but $200, 2 hour drive.
I will say,
One person, once a year.
I would encourage,
So you'll handle it?
if any of you are interested in going, I think it would be a good exercise. When you get all freaked out by hearing all these things, please come talk to me first, and we'll walk through all the issues and see what are things we really need to be concerned about and what are things we already have handled. Because I leave every one of these roundtables freaked out about something, but it turns out we've already got it handled. I just didn't know it. So,
All right.
okay, good enough there. A lot of you have asked me questions about the League of California Cities Retirement System Sustainability Study and findings. I included some pages from that report, kind of the executive summary, and my personal favorite page was the, where'd it go? Page 29, I believe it is, of the report, which has the primary factors contributing to CalPERS funded status. And the list of culprits there looks eerily similar to some things we've discussed here. Benefit increases, investment losses. We did not specifically look at the cost of living adjustments. but those are an expensive component of a plan. The contribution policy for CalPERS. It's interesting to note that CalPERS just last week, I believe, changed their amortization schedule from a 30-year to a 20-year. We made the decision to go from a 30-year open-ended to a 30-year closed in 2009, and then in 2012, I believe it was, we moved to the 18-year closed layering approach. So we made changes, started making changes a decade before CalPERS, and made much more aggressive changes than what they have already made in their funding policies.
I agree.
Well, CalPERS also has a 17-year smoothing,
Oh, my gosh.
and
Wow.
they retroactively granted all of their folks the benefits that were made. And there's no retroactivity, I know, in CalSTRS.
There was some of that in Mendocino
In
County.
probation, right? Was it probation?
When we were having a conversation with Jim Anderson Monday, and I'll mention that a little bit, I'm thinking he said the city of Cloverdale has a retirement tax that they put into place. Was it a retirement tax or?
I thought it was a bond.
No, because every time, it may have been something to cover the wages of their city workers, or, no, I think it had, they're in CalPERS, and I think there was a tax that every time they get an increased benefit, the tax goes up, and it's like a parcel tax. So everybody in the city of Cloverdale pays for increases in retirement issues.
A number of cities are starting to do that.
Is it already in effect, or is it going to the ballot?
According to what Jim said, I think it's
Already
already.
there, okay.
Well, that was one of the suggestions or possible solutions mentioned in the Cal City's report. Was taxes and parcel taxes and loss
That
of
would go over like
other
a
things.
Wouldn't
ton of
it?
bricks.
Would it?
Oh, yeah.
My goodness,
Yeah.
that would cause a lot of interesting
Yeah.
responses from one or two folks.
It's not really an issue here because this board has already taken all of the proactive steps that we have to address our funding issue, the unfunded liability here. We have a plan, it's a solid plan, we're working the plan. We are moving in the direction of 100% funded. So, it's not, the contribution levels have increased markedly over the past decade. That's purely a result of, there were investment losses that we had to realize, but, it's a different economic environment today than it was 10 years ago. We've lowered our investment assumption prudently, not in a one fell swoop kind of approach, but prudently to manage this and move in the right direction. I can easily foresee a time when we will be talking about raising our investment return assumption. It is out there. I don't know how far it is out there, but it's out there. It's very real. That 7% is going to be too low given where we are in the world at that time. The days of getting 10% in the stock market will come back. And when that happens, we'll be talking with the actuary about, through the experience study process, do we need to raise that? So
That would
I'm
be
not
so
making
nice.
any recommendations there, but I'm just telling you,
I move.
I see that day coming. Probably not in the next experience study, but maybe the one following that, there might be some discussion around it.
Wow.
And if not not the 2023, then probably the 2026.
Sure.
So,
Demographics, there's nothing anybody can do about demographics in these mature retirement plans. I mean, what can you possibly do?
reinstall the smoking lounges?
Still trying to think of a joke.
That was one.
Can't beat that one.
That is the Midwest economist joke.
If where your water from Flint?
Yeah, right.
It is hard to look at our returns, as Callan just went through, and you look at the bottom line, 1, 3, 5, 7 years, and they're 8.5, 9.5. Now that we've gotten out of 2008, and that's not dragging us down, it's hard to look at that and say, why do they think we're not gonna get 7%?
And we just keep doing that till we're at 100% though.
Yeah,
If we're 100, 110, then we could look at lower.
yeah, absolutely.
But it's just, there's just no, yeah, I just could never, I mean, unless we were well over 100, I could never raise the,
So to
Raise it back
back to
up.
the CalPERS report that League of Cities has, to me what's interesting about this is the fact that CalPERS is as far behind us in some ways
Yeah.
that I wasn't realizing, because
Yeah.
we focus so much on the assumed rate of return and a couple other items like longevity. And I think CalPERS is not lagging behind us all that much on those fronts. I mean, they're tracking fairly closely. But I wasn't aware of the way they were spreading their losses and amortizing new unfunded liability, that those reforms are just now kicking in over
Yeah.
at CalPERS. So,
Yeah.
because when you
It's
look
like
at
a great big
their
shift.
projected increases from 18-19 to 24-25, just looking here at the cities of Mendocino County that are in CalPERS, they're actually not even in the worst condition of all the cities in California, but they're in the 20 to 40% increase for public safety employees, contribution rates 40 to 50% for non-public safety, and they're not even in the worst bucket of all the cities in California. So clearly that they are lagging a little bit, and they're now kind of implementing more reforms at CalPERS that they should have kicked in 5-10 years ago.
yeah. Well, everybody was watching us. I mean, it's what it appears particularly here. I mean, everybody's watching us. Nobody was looking at anything else, and we have done a lot of things. I mean, we've made a lot of good decisions over the last, probably particularly 6 to 8 years. I mean, we have more to go, we have more to do, but still, we got a long way.
CalPERS board members represent, pardon my, various unions. With the couple that are not, but much more strongly than what we have, or that we have in CalSPIRS.
Yeah, and just to add to that too, the other thing that has not hit and will not hit us, and we keep going back to it here, is because we don't have retiree medical. And other cities and counties are gonna get hit, they're gonna get hit hard with that. That's not gonna hit us. And that's what, that's one of those things that's out there that people have to look at that. And all of a sudden, it's gonna blow up and everybody's gonna go, holy cow, look what this new unfunded liability is. We don't have that. Ours is zero. We don't have that.
Provides medical for
Yes.
everybody in the state.
Yeah.
Well,
And their spouse, and their significant other.
So every city's different, and every city has their own contracts with their employees, and so, I think it's probably, I assume it's fair to say that a majority of cities did phase that out for new hires as of a certain point. So I'm familiar with some cities where they did that.
Medical?
Yeah,
Okay.
so you'll have people who are still retiring that will have it in retirement. I know the city of Fort Bragg, for example, had retiree health care for employees hired prior to a certain date. I forgot the actual date. And originally there was no requirement for the employees to enroll in a supplemental once they were eligible for Medicare. Over time, the city said, well, we can't afford to provide you the primary care. You're Medicare eligible. You need to enroll in Medicare, and we'll pay for a supplement. So things like that have been put in place in lots of cities.
Yeah.
So I don't know that it's.
Which helps, but it doesn't do away with the whole
Well,
issue.
again, those were those who were
Yeah.
hired prior to a certain date.
Yeah.
Those hired after a certain date
Yeah, you
don't
still-
have retiree health care.
Yeah.
Are
Yeah.
cities exempt from the Affordable Care Act?
We were talking about retiree health care. No, they're. I don't.
As far as providing
No,
medical for employees?
I think before the Affordable Care Act, there probably wasn't a city out there that wasn't offering health care to their employees anyway. But even if there was, they would be subject to it, I would think. Any employee.
Are you asking about the county?
Right.
Yeah, I think because they have an established plan.
Okay.
They're not part of the Affordable Care Act. Yeah.
Well, the county has its own
The county has its own
sponsored plan.
self-insured, yeah.
Oh, okay.
They still
So
have to
that's-
revise part of it after the act passed. Some parts have to be revised for our own health plan, but.
But cities being smaller generally would, pay a company for a healthcare plan normally.
Yeah.
We had that for a while, before we completely dropped retirees' health insurance in about 2008. If you started working for the county after September something in 1998, you didn't get health insurance when you retired.
Yeah.
Then we phased it out entirely.
Yeah, but even with that, you're still gonna have a liability because you're gonna have some people here that are baby boomers that could live another 20, 30 years that you promised them insurance. So you're gonna have one heck of, even with that, even if you cut off what you're doing, you're still gonna have a liability for an OPEB
A
liability.
different thing, I was gonna ask this, but I forgot when we did the cost of living, and you look at that table they give us, they're going back to 1971. Anybody who retired in 1971 has a bank. Do we have people who have been retired since 1971?
Yes.
30-some, 40 years?
Not necessarily
I can't do the
71,
math.
but we do have,
Oh, continuing?
we do have some retirees that are in the various buckets where they have a bank. I believe there are 28 total retirees, don't quote me on that number. It's less than 30 that have something in their COLA bank. So,
Okay, thanks for that informational item. And then there's the King Court update you have.
yes, just wanted to advise the board that I've canceled the landscaping project this year.
Yes,
The bids came in for the project, more than double what the board had allowed. And it's your favorite culprit, the prevailing wage. And done some investigation, there is no way we can get around that. No way legally we can get
Except to
around
donate
that.
labor.
There you go.
I'm a master gardener, we'll get a bunch of master
Get
gardeners to go out to
volunteers,
it.
right.
If,
The trustees who don't go to the calipers.
Yeah, yeah. Not the
You find the hot
volunteers.
dogs will all show up with gloves?
A voluntold
Saturday
work.
I see a lot of you
You
in
can
Oakland.
do that, don't laugh.
we are required to, for all of our for the projects we contract largely to be subject to prevailing wage, which adds to their projected costs very markedly. If we didn't follow the prevailing wage guidelines, there is a very significant fee should we be caught. So it's what we have to live with. I am aware of, just to put this in perspective, there is another plan in California that has built their own building. And their estimate is that prevailing wage has cost them about 50 basis point in annual return on their building. So just file that factoid away, it's something to think about.
If we rented a building from a landlord, Joe Schmidt, does Joe have to hire prevailing wage to do the landscaping?
No.
The county doesn't own this building. The employees own this building.
It's public money,
Why?
and therefore subject to,
How?
I've asked the question. It is public money. I don't like that answer, but I'm told it's public money.
We need our lawyer to.
And that's
just
what
wanted
I
to give
asked.
the answer to.
Guys, I am having eye surgery in Santa
Oh.
Rosa at 1:30.
Oh, drive
I have to
carefully,
go, thank you.
both ways.
Yeah.
Hopefully somebody else is driving
Yeah,
you.
somebody driving you home?
Driving me back, my daughter.
Oh, good.
Good luck.
Yeah, thanks.
So-
Not a biggie.
Right.
This is for you.
Thank you. So that is a factor we're gonna be thinking about. We will adjust our estimating procedure going forward on what projects are going to cost us.
Well, if we bought an office building in Nevada as an investment, would we have to have prevailing wage or say it was in California? Would we have to have prevailing wage for property management services, for the roofer, for the landscaper? I don't think so.
And
We
you also
would
have
have
the
a
properties in
property
Nevada.
manager, and the property manager's job would be to hire people to wash the windows and do everything you have to do to maintain a building. This building is held for investment. I'm just not buying this stuff that we have to do prevailing wage for a building that's held for investment. I'm not buying it.
That's interesting because we're not the primary tenants of this building. We have occupied less than 50% of the building. It's an investment property, isn't it?
Yeah.
I have made arguments. I have been told it's public money. Everything we do, almost everything we do is subject to prevailing wage. Anything over a dollar threshold is subject to prevailing. That involves contractors.
Is that from Ms. Elliott?
It's from our office.
Oh.
It's from our council.
So there is a higher power.
I had a question. It's something I hadn't considered before because I assumed contracting out would be better. But I know Facilities and Grounds have done a lot of landscaping projects here, at the county building. I mean, is that an option that maybe we should look at? I never thought of it before.
They don't have the bandwidth.
They just can't field that. Okay.
At this point, they don't have the capacity to take on a project like that.
Got it.
They are helping us with some other projects. The work, some of the work in the break room area that we're having done, facilities will be handling, but
Not this.
not this.
Okay.
They don't have the capacity for that. So
Okay, you got
I
two
don't
more.
like the answer either. But the penalties are extreme. I think the number that was thrown at me was $30,000 per event.
Oh, geez.
So, Form 700 reminder, they're due to Judy by April 2nd.
So you actually need a copy of them?
Yes.
Yeah,
Okay.
just a copy of yours with your original signature would be,
The original signature?
you
It's just a copy.
print a copy and sign it.
Oh,
But you're gonna file them, or do I need
They,
to file them?
they file with me.
Okay.
Yeah.
We're not
Oh.
required, so.
We're not
see,
required
I already
to send
filed
it to
mine.
the
I was already
FPPC.
filed mine with the recorder's office.
Yeah, but I need a printed copy with your original signature. How's that?
Okay.
Because I have to have
For-
it for
for yours.
public inspection
Okay.
here.
Okay.
So they don't go off anywhere else, okay.
And I attached a copy of the updated work plan after all the changes we made last month. Thanks to Judy for reminding me of that. I think that concludes my report, unless there are any questions.
Just briefly, we were talking about workshops we went to. I went to one day of the Callan workshop and found a hotel that was less expensive than the one they were sponsoring.
The Palace?
Anyway, but the two things I thought I'd take away, I just share that one, Callan was showing their projected revenues or investment returns and inflation background, and it looks like it's tracking pretty closely with where we're at. Even though the expected returns are lower, so is inflation by a little bit. So it feels within the comfort range of where we're at with what they were showing historically and where they're projecting. And the other is the keynote speaker, you might say, was the editor-in-chief of The Economist, who I thought was really interesting, and she was looking at the horizon of potential storms in the economy, and for the most part was thinking things are likely to be fairly calm in the foreseeable future, but her one area of, that you can't really quantify is North Korea and what they may cause by something they do. So that seemed to be her major qualifier on the economy for the foreseeable future.
She had the room, wow. She was fabulous.
The speakers there are amazing. They're just amazing at
Well,
Callan.
then there was
The Hidden Brain author.
Yeah, that was interesting. But the speakers on computer safety. It was like, we're doomed. We need to be really serious about it. And how did he put it? Not apathy, but anyway, we're all doomed. He pointed to the room and said, well, 70% of the people in this room have already had all their information taken.
Oh, really? It's comforting, huh?
Yeah.
You never leave a cybersecurity presentation feeling any degree of comfort.
True.
It's their job to scare the bejeebers out.
Yeah, they did a good job.
Is this general board discussion? Okay. I want to comment, compliment James. I don't know if everybody knows, there's a AMCRE, the Association of Mendocino County Retired Employees, and they had a general meeting on Monday, and James was our program and did an excellent job. Brought information for everybody, and wisely, I think, after maybe 5 minutes or so, turned it over to questions, and there were some good questions and good answers.
Thank you.
Good job.
I did, Catherine let me know last night that she had a situation at home where she would not be able to be here today, but she did want me to advise the board that she has submitted her paperwork to run for the Sackers Board of Directors as secretary again this year. So she just wanted to make everyone aware of that.
Well, if that's it for general discussion, we have 2 closed session items.
Oh, I've got one thing, I don't know if I should just talk to you about it, but we talked about the concept of investing in limited partnerships, like for apartments. And I was mentioning that to the investment manager at Loma Linda University, who is a client of mine, but unrelated. And all the great things, magical things they've been doing for the last 10 years. And he volunteered to come up and speak with us, to share how because it took them a year to set up all their policies and procedure. I mean, they're over $1 billion foundation, and they do everything right, like we do. And so he volunteered to come up, and also I was talking to their advisor for real estate that does their outside analytics and all the fiduciary work on the partners that they invest with and the individual projects. And he volunteered to come up to give us a presentation at the same time. So that's something for us to consider. These are gold-plated guys they're getting returns in the 20-25% range on their apartments, which they've been doing for the last 10 years. And they buy other types of real estate too, but and I think that this is a kind of investment that can really make a big impact on a small pension plan like ours. So if you're interested, I think we could think about it and extend them an invitation. And of course, we'd have to pay their way up here, but so.
Very good.
Okay, any other general, okay, so I don't know, do we list the 2 the 2 closed session items?
We sure could. I don't have the agenda handy, but I'll.
One's a possible initiation of litigation. The other is Steve Adams, correction deputy, service connected disability retirement appeal.
It's like right in my bag.
Yeah.
It's in the car out there.
In the anticipation litigation, no action taken, and on the Steve Adams case, direction given to staff and council.
Okay, with that, we're going to adjourn the meeting at 12:56.
I thought we were going to be out of here by 11:30 or 12.
Presentation took a while.
Alan just kept going and going.
Shouldn't be there, but how do I delete it?